Okay, good morning everyone. Welcome to Byju's Exam Prep IAS. This is Shyam Gagodia. Now, before I start the discussion, if there is no issue with the sound, can you give me a thumbs up? Yes, thumbs up. Anyone is okay. Thanks a lot. Thanks a lot. Now, before going forward, what we have discussed yesterday we started with the concept of banking. Right? In banking, what we have discussed, I'll put in a nutshell here. In banking, we started with idea of the money, concept of money. So in banking, we started with the concept of money. That was the first. 4 types of money. Please be very careful. Revise all the 4 types of money. So first one was money, fiat money, fiduciary money, commercial bank money. Then there is commodity money. That was the first one. After money, we discussed the idea of banking structure in India. What kind of a banking structure we do have in India? I remember the structure. At the top of the banking structure, we have Reserve Bank of India. RBI regulates everyone in the Indian market. Right? For example, it could be scheduled commercial bank. It could be a public sector bank, private sector bank, right? RRBs, cooperative banks. All of these come under the regulation of Reserve Bank of India. After the structure of bank, we started with Reserve Bank of India, RBI. And we are still there itself. We have not gone after that. We are still there itself. That is, Reserve Bank of India was established on 1st of April 1935. I repeat, Reserve Bank of India was established on the 1st of April 1935 with the passage of RBI Act of 1934. And Reserve Bank of India initially was located in Calcutta. It was shifted to Mumbai 1937. And since 1937, it is there in Mumbai only. Then we had a look at some of the important sections of RBI Act of 1934. Important sections. Section 2, Section 8, 22, 47, etc. Then we looked at the structure of Reserve Bank of India. Structure of Reserve Bank of India. The most important part of Reserve Bank of India is the Central Board of Directors. Composition is simple. 21 members are there. 1 plus 4 plus 10 plus 4 plus 1 plus 1. Reserve Bank of India is headed by the RBI governor. RBI governor is appointed by Government of India. There are 4 deputy governors appointed by Government of India. There are 10 experts appointed by Government of India. 1 member each from local boards, right? They are representing. In addition to this, Finance Secretary and Economic Affairs Secretary are the members of Central Board of Directors. After this, we started with functions of RBI. And I told you functions of RBI are very, very important. Functions of RBI are very, very important. What are the functions we have seen? 1, RBI is important in terms of controlling inflation. RBI plays a very, very important role in terms of controlling inflation. Now, let me ask you a very simple question. You should know the answer by now. Can RBI control every type of inflation that happens in the Indian economy? I'll repeat the statement. Can RBI control all the types of inflation that happens in the economy? We have discussed this, by the way, and I'll connect it to current affairs. Just give me a second. The answer to this is no. No, RBI cannot control all the types of inflation. It doesn't have the tools to control all the types of inflation. So what do you mean? We have discussed so much regarding RBI's role in inflation. Now you're basically changing your whole argument. You're saying that RBI cannot control all the forms of inflation. In fact, I made a point of mentioning this when I discussed inflation. I said RBI through its monetary policy can control the regulation, can control the money supply in the economy. And money supply is used for demand side of the economy. What about the supply side? What about the supply side? Can RBI control the supply side inflation? Very, very limited scope is there. So why are we discussing this? Please read today's article in Hindu, page number 14. Please read today's article in Hindu, page number 14. There's a very nice article, 2 articles in fact. Right in the central, that is in the page number 14, top center part, Finance Minister has talked about role of RBI in controlling inflation. Please do read that. And besides that only, the Finance Minister is saying, right, the Finance Minister is saying, RBI doesn't have to follow all the banks around the world just to control inflation. RBI doesn't have to do that because RBI doesn't have all the tools to control inflation. Rather than controlling inflation, RBI should also focus on promotion of growth. That is the gist of the statement given by the Finance Minister. And just beside that article, there is one more article which says, one more central bank, right, foreign bank, central bank has increased the interest rate in order to control inflation. Beautiful article. Please read it. So any other article is important apart from this. There is one more very important article. Again, we have discussed. You don't have to behave as if you need to go to Mars to understand all of it. There is one more article in page number 11, Hindu, page number 11. And it says that Finance Minister, again, statement of Finance Minister only. Finance Minister has criticized the state governments for not reducing the taxes on petrol. Simple. Finance Minister has criticized the state government for not reducing the prices of, taxes on petrol. So what is this? I hope you remember we have discussed, when I discussed taxation specific and ad valorem, I gave you an example. The state governments impose a tax which is ad valorem tax, sales tax or state duties on petrol and diesel. And in addition to this, even the central government imposes a tax but per litre, that is a specific type of a tax. And I said in the last couple of years, both central as well as states have been racking up, have increased their taxes, collected a lot of tax revenues. But the Finance Minister argues that in the last couple of months, we have reduced the taxes, states have not reduced the taxes. And you can see the states where they have not reduced the taxes on fuels, those states experiencing higher inflation rate. Right, so that is one more important article. A lot of concepts are there. Please go through that. Right, there is one more important article. Meanwhile, I'm telling you, there is one more important article, page number 10. Page number 10, there is one more important article on cooperatives. Please read that also. But I found one problem with this particular cooperatives article. That is basically Mr. Amit Shah, who is the Minister of Cooperation now, has given a speech, has given a statement. And information is provided. The only fault I found with that article was they have not covered all the important relevant points there. For example, in one more newspaper, Business Line today, as well as Business Standard today, they say that the ministry, that is the Ministry of Cooperation, that is the Government of India, have announced that they will set up multi-state cooperatives. Multi-state cooperatives in certain areas, such as exports. Right? They have proposed that they will set up multi-state cooperatives in other areas. That was not mentioned. I found that was interesting. They have not mentioned that in the Hindu newspaper article. So just be very careful. And so come back to the original point here. That's a D road. Please go through the articles. Important information is there. You will be able to understand those articles. It should not be very difficult now. Tax on fuels should not be difficult. Is RBI equipped enough? Right? Can RBI control all the forms of inflation? You know the answer because we've discussed all of it. Please go through the articles. The functions of RBI, come back to this. Inflation. Inflation, the role of RBI, monetary policy framework agreement, RBI has to control inflation, 4%. Then we've discussed the role of RBI in supply of money, printing and distribution of money. Specifically within money, it is the currency notes which is printed and distributed by RBI. Then role of RBI as a banker to government. Role of RBI as a banker to government. What is the public debt, internal debt, external debt, how much is internal, how much is external, how does RBI help the government of India to borrow money from the market, etc. We have discussed. Then right after this particular concept of banker, we started with the monetary policy tools. Monetary policy tools. or credit control measures. Credit control measures. And this is where we took a pause yesterday. I remember this. Right, the monetary policy tools, two types, quantitative, qualitative. Then we had a look at repo rate. Right, so let's pick it up from there. What is the repo rate? It is a rate of interest which is charged by RBI, Reserve Bank of India, whenever they provide short-term loans to banks. Simple. RBI will give short-term loans. Sir, what do you mean by short-term loans here? Overnight, that is 1 day. It could be for 7 days. It could be for 14 days. It could be even for 28 days. So whenever overnight loans are provided or short-term loans are provided, RBI charges a rate of interest, and this rate of interest is called as repo rate. Now come to the second one, reverse repo rate. Reverse repo rate. What do you mean by reverse repo rate? It is the rate of interest charged by the banks on the short-term loans given by them to RBI. Don't be confused. It is a short-term loan that is given by a bank to RBI, and on this, a bank will charge a rate of interest. Now, first and foremost, rather than saying that, sir, why will RBI borrow money from the bank? Understand the concept here. Imagine, imagine you own a bank. You're a bank manager. You have lot of money. You have lot of money. Now, you want to lend in the market. You want to give loan in the market, but it is very risky to give loans. Very risky in the sense. Let me give a very simple example. You'll understand. In the last 2 years, because of the pandemic, is it okay if I say that it was risky for the banks to give loans in the market? Right? Either say yes or no, I'll understand. Either do this or do this, I'll understand. In the last 2 years, because of the pandemic, was it risky for the banks to give loans in the market? Of course, yes. Sir, why it is risky? Right? Some of you are saying no, sir, it was not risky. When there is a pandemic, companies are unable to manufacture and sell. They are not going to earn revenues. So how can you expect them to repay the loans? So it is risky to give loans during these kind of situations. But you have a lot of money. You have collected a lot of deposits. Now, what should you do with the deposits? RBI says, I will provide one facility to you that is basically reverse repo. Right? I'll provide you one facility, reverse repo. Under the reverse repo, what you can do is the bank can collect these particular deposits and give these deposits or deposit this money with RBI, with the Reserve Bank of India. And as a result of this, Reserve Bank of India, whenever they will collect the deposits, either let's say for overnight basis, 7 days, 14 days, 28 days, etc., RBI will provide a rate of interest to the bank. Same example, step 1, step 2. I remember this. Yesterday in repo, I've discussed this. Step 1 is bank giving deposits to RBI. RBI will give G securities to bank. And let's say after 7 days, RBI will return back the money, the deposit money along with the interest, and the bank will return back the G securities to Reserve Bank of India. Like the same concept of repo rate, only difference is in repo rate, it started with RBI giving money to bank. Whereas in reverse repo rate, bank will give money to Reserve Bank of India. Right? Everything else remains same. Right? One arrow mark is money, another arrow mark is the G securities. Second step, the RBI will return back the money along with interest. The bank will return back the G securities. Now this is basically the reverse repo rate. Now I'll ask you a very simple question. You have to answer it. Imagine you are RBI. Imagine you are RBI, that is RBI governor. Do you want the repo rate to be higher or reverse repo rate to be higher? Answer this very carefully. You are the RBI governor. You want the repo rate to be higher or reverse repo rate to be higher. And henceforth, these are the short forms I'll be using. Whenever I say, right, some of you are saying reverse repo rate. Please be very careful. The right answer is, sir, repo rate should be higher. Why? It makes perfect sense, by the way. You are giving a loan, you should charge a higher rate of interest compared to rate of interest when you will pay. Have you understand this? Let me give a very simple example so that you understand this. Imagine you want to borrow from a bank. Right? You'll go to bank. Imagine you're ABC. You want to take a loan from a bank. That is a situation 1. Situation 2, you have money. You'll keep this money in the form of deposit with the bank. Now you tell me under which of the 2 situations, yes 1 or yes 2, the rate of interest will be higher. Under yes 1 or yes 2, right, the rate of interest, please be very careful, rate of interest is higher. Right, the answer is, sir, under situation, rate of interest is higher. Some of you are saying situation 2, I don't know why. You go to a bank, you keep a deposit, you get 3%, you will earn 4%. You take a loan from the same bank, they will charge you 7%, they will charge you 8%. So obviously the rate of interest that they charge is higher compared to the rate of interest that they pay to you. And sir, why do they do that? They want to earn profit. Is it not? Let me know. They want to earn profit. Imagine a bank will give you for every 100 rupees, the bank will give you interest of 7 rupees, but when they give you a loan, they will collect 5 rupees from you. If they do that, they are incurring loss there itself. In the same way, please be very careful. Right? In the same way, that somebody says, sir, arrows are both in same of the situations. I said, here you want to take a loan, here you want to keep a deposit. That is the reason. Okay. So in case of the same situation, you apply in case of RBI, Reserve Bank of India. RBI is giving a loan, RBI is taking a loan. So obviously RBI will charge a higher rate of interest when they give loan. So remember this, repo rate will be greater than reverse repo rate. Repo rate will be greater than reverse repo rate. Let me go to the next one. One more very important credit control tool, standing deposit facility. Important. Why? This has been introduced by RBI very recently. This has been introduced by RBI very recently. Books do not have the information on this. Follow the discussion here. What is a standing deposit facility? Rate of interest charged by banks when they lend to RBI for short term. Now, before you start saying that, sir, it is reverse repo rate, please wait. Let me differentiate. Let me explain to you. Then you'll understand it. What is a standing deposit facility? It is a rate of interest that a bank will charge whenever they give loan to RBI for shorter duration. How short? Overnight basis, 7 days, 14 days, etc. So, but there is already a reverse repo rate. If there is already a reverse repo rate, what is the need to introduce one more tool like this? Don't you think both are one and the same? No, both are different. Understand this very carefully. First very important point here is, what happens in a reverse repo rate? A bank will approach RBI, deposit money, and collect G securities. Any doubt? Let me know. RRR here simply refers to reserve repo rate. Reserve repo rate. Don't say, sir, you're writing a movie name. No, it is a reverse repo rate. Now understand this. In a reverse repo rate, bank will deposit money with RBI and in return collect G securities. Now let me ask you a very simple question. Imagine 2 banks, A and B, have taken their deposits, approach Reserve Bank of India. They want to keep deposits under the reverse repo rate. But RBI says, I do not have sufficient G securities. Have you understand this? I do not have sufficient G securities to give as a security, to give as collateral. A has, let's say, 100 crore rupees. They want to keep with RBI. B has another 200 crore rupees to keep with RBI. Generally, we take 100% of the value in the form of collateral. Now, RBI should have how much worth of G securities here? 300 crore worth of G securities. Now, the problem is, what if RBI doesn't have so much worth of G securities? Can they start printing a G securities? No, they cannot do that. Now, the problem arises here. There is a tool called as reverse repo rate, but RBI doesn't have G securities to provide as collateral. Don't you think reverse repo rate will fail in the situation? Citing this only, understand this carefully. Citing this only, RBI has introduced a new tool, standing deposit facility. Let me go to the second very important point here. Whenever you come across the term standing, this is a trick, remember this. Whenever you come across the term standing, it simply means this facility is available throughout the year. I hope you understand this. Whenever you come across the term standing, I'll give you one more example. Marginal standing facility, which we'll discuss later, don't worry. Whenever you come across the term standing, it simply means this facility is available throughout the year. On any day, you can simply approach RBI and use this particular facility. Now compare these with other system here, that is reverse repo rate. In reverse repo rate, the RBI requires G securities. RBI needs to provide G securities as collateral to the bank. Now look at the standing deposit facility. Look at the example of standing deposit facility. Here is Reserve Bank of India and here is a bank. The bank will deposit the money with RBI, and let's say after 1 day, 7 days, 14 days, etc., RBI will provide the money along with the interest to the bank. Now, very simple question to you people. The picture is there in front of you. Answer me. Is there any G security involved in the standing deposit facility? Is there any G security involved in the standing deposit facility? Answer is no. Right? I understand this. Answer is no. There is no security. There is no collateral provided by RBI. Whereas in the reverse repo rate, in fact, I've given you an example here also. Right? Is the G security involved in the reverse repo rate? Yes, the G security is involved in the reverse repo rate. That is one very, very important difference. Don't say that both are one and the same. No, one of the very important differences is collateral is not given under standing deposit facility. Second very important difference. The reverse repo rate is not available throughout the year. It is not available throughout the year. RBI will say for next 14 days, reverse repo rate is available. Next, they will simply say next 28 days, right? The reverse repo rate is available. But under the standing deposit facility, I've already told you this. Is it available throughout the year for the bank? Of course, yes, it is available throughout the year. So don't get confused between the reverse repo rate as well as the standing deposit facility. Now let me ask you a very simple question. I expect your answer, correct answer by the way. There is one facility where collateral is provided. Understand this carefully. There is one facility where collateral is provided. There is another facility where no collateral is provided. No collateral or no security is provided. Now you tell me, rate of interest under which of the two facilities should be higher? You tell me. I'll repeat the statement by the way. In one of the tools, collateral is provided. In one of the other tools, collateral is not provided. Right? In which of the two tools or facilities, rate of interest should be higher? Obviously, it has to be facility 2. It has to be situation 2. Sir, why? If you ask me why, some of you are saying 1. Be very, very careful. Why is the rate of interest higher under the facility 2? Reason is, if no collateral is provided, you take higher risk. Simple. If no collateral is provided, you take higher risk. Higher risk means returns should be higher. Interest rate should be higher. Does it make sense or no? Let me know. That simple knowledge you applied, you will get the answer for it. And here I want to correct the formula now. Earlier repo rate was the highest. Reverse repo rate was the lowest. Now there is one more tool, standing deposit facility. Standing deposit facility will be between both, that is RR and triple R. Remember this. Standing deposit facility, right, is more risky for a bank because they are not collecting any collateral. Hence RBI says, I will give you more rate of interest under STF. Because many of you will ask me, sir, if reverse repo rate is more safe, if I can get collateral, why should I use STF? Answer is higher rate of interest. Simple. Higher rate of interest. If you're going to earn higher rate of interest, that too from RBI, why not? You will choose STF rather than reverse repo rate. Is it okay? It should make sense to you, right? It is available throughout the year and it will provide higher interest to you. So rather than choosing reverse repo rate, you will choose SDF. I will use a statement now. Understand the statement very carefully. UPSC can ask you this. Because STF rate of interest is higher, banks are preferring SDF now. Reverse repo rate for all intentions and purposes has become useless. I'll repeat the statement. Because the rate of interest on SDF is higher compared to triple R, banks have started using SDF. Triple R for all intentions and purposes has become useless. Why? If you start using SDF and do not use the triple R, what is the use of triple R now? It has become useless. This can be used. Please be very, very careful. This can be used. Please be very, very careful. Okay, so reverse repo rate very high, highest amongst the, followed by STF, followed by triple R. I'm writing in descending rate. Please be very careful. Next one is a bank rate. Next one is the concept of bank rate. What is this bank rate? It is the rate of interest charged by RBI on the loans given by RBI to commercial banks. Right? Don't get confused with all of these tools. Let's go one by one. Let's differentiate also so it is clear to you. What is the bank rate? It is the rate of interest charged by RBI on the loans given to commercial banks. Who will give loans here? RBI is giving a loan and charging a rate of interest, and that rate of interest is nothing but a bank rate. Now, many of you will basically point out, sir, repo rate is also the same thing. Follow the next explanation very carefully. Many of you simply point out, repo rate is the same thing. Even under repo rate, you said RBI will give loans and charge a rate of interest, and you said this is nothing but a repo rate. Both are not one and the same. Understand this very carefully. Look at the process here. Step 1, RBI will give loan to a bank. Step 2, RBI will collect money along with the interest from the bank. Now, this particular rate of interest that I'm charging is nothing but bank rate. The rate of interest that I'm charging is bank rate. Now, you already have seen the picture of repo rate as well as bank rate. You tell me, are both one and the same? Have you understand this? You tell me, are both one and the same? Right? Your answer should be no. Right? Let me show it just for more clarity. So I forward the picture of repo rate. This is the picture of repo rate. Right? What is the difference? Securities. The difference is securities or government bonds collaterals. Under repo rate, please understand, distinguish between both very, very carefully. Repo rate is a type of open market operation. I hope you remember this. Yesterday we have discussed. Repo rate is a type of open market operation. What happens in open market operation? RBI sells or purchases G securities. That is open market operation. And does RBI purchase and sell G securities under the repo rate? Yes. RBI purchases and sells G securities under the repo rate. What happens under the bank rate? Under the bank rate, RBI will simply give a loan. That's it. RBI simply gives a loan, charges a rate of interest. And that rate of interest is called as bank rate. Very, very important. Do not be confused here. Do not say that, sir, everything is one and the same only. No, all the tools are not one and the same. RBI will use these particular tools as per the requirement in the economy. Right? That is the concept of the bank rate. Next one, statutory liquidity ratio, SLR. I'll be discussing two concepts here. One is SLR. Second one is CRR, cash reserve ratio. SLR and CRR. Now let's start. Follow the picture very carefully. Sir, which picture are you talking about? I'm talking about this particular picture. Can you see the color now? Can you see the marker? I'm basically identifying particular part of the slide. I want you to have a look at this picture. What is the picture? What information you need to derive? Here is a bank. The bank will collect deposits. Any problems? Let me know. The bank will collect deposits. The bank will give loans. Loans will fetch returns to the bank. Is it okay? The bank is giving a loan, and on loan, bank earns money. Loans are assets of the bank. And right, look at the next point here. Bank has collected the deposit, and the bank is giving interest to the customers. Bank is giving back the deposit along with interest to the customers. I'll call this as a liability. Any doubt in this picture? Let me know. Any doubt in the picture? Right? What I'm trying to simply say is the loans are assets for the bank, and the deposits are liability for the bank. Right? Basically, argument is simple. Anything that will lead to inflow of money, anything that will fetch returns to you, we call these as assets. Anything that will lead to outflow of money from you, that is called as a liability. Imagine you have kept 100 rupees with the bank. Will the bank give you that money back? Of course, yes. Along with interest, by the way. So that is a liability for a bank. And if a bank has given loan to you, they will collect back this amount along with interest. That is an asset for the bank. Now have a look at this very carefully. When you look at the liabilities, right, what do you mean by these liabilities? The deposits are nothing but liabilities. The deposits collected by the bank are liability for a bank. Now the deposits are divided into two parts. Deposits, there are two types. One is called as a time deposit. Second one is called as demand deposit. One is a time deposit. Second one is a demand deposit. I'll start with an example. Demand deposits, savings bank account. Savings bank account. And a time deposit, fixed deposit. FD. You must have heard your father or your mother saying, I kept a FD of 2 lakh rupees, 3 lakh rupees. Now let's start. What do you mean by demand deposit? Demand deposits are those deposits which can be withdrawn by the customer whenever they want. Whenever there is a rise in the demand, the bank will allow the customers to withdraw these deposits. For example, imagine you have a salary account. That is a type of savings bank account, by the way. You have a salary account. Can you withdraw the money at any point of time? Have you understand this? Right? Can you withdraw the money at any point of time? Of course, yes. Bank cannot say, sir, no, I will not allow you to withdraw money. No, they cannot do that. So whenever the demand arises, you can withdraw the money. Right? The money will be allowed to be withdrawn with a rise in the demand. Such deposits are called as demand deposits. Second, time deposits. Imagine you take 100 rupees, keep it with the bank for 1 year. That's a fixed deposit, by the way. That's an example of a fixed deposit. You keep this FD for a duration of 1 year with the bank. But what does it mean? For 1 year now, this money will be there with the bank. So what is the meaning of a time deposit? These are the deposits which are there with the bank for certain number of days. I'll repeat the statement. These are the type of deposits which are left with the bank, which are kept with the bank for certain number of days. It could be 7 days, it could be 1 year, it could be 7 years, it could be 10 years also. So time deposits are a liability for a bank. Demand deposits are also liabilities for the bank. Let me know if there is any problem related to this. Any problem related to this, let me know. Liability simply means you have an obligation of repayment. Please revise. This is my suggestion to you people. Revise it. Why? It is not the first time I'm telling you the idea of asset and liability. Already we have discussed it. You are not revising. Simple. So liability means you are supposed to repay. Asset means you will earn on it. That is asset and liability. Right? So time deposits and demand deposits, bank is supposed to repay the money. Hence these are called as liabilities. Now take the sum total of both of them. Take the sum total of both of them. We'll simply refer to this as gross demand and time liabilities. Gross demand and time liabilities. GDTL, gross demand and time liabilities. But there is one more term, net demand and time liabilities. NDTL, net demand and time liabilities. What is the difference here? Understand this carefully. When you count all the deposits that are there in a bank, you also count interbank deposit. Interbank deposit. What do you mean by interbank deposit? I'll use a short form here, IBD. One bank will keep a deposit with another bank. I understand this. One bank will keep a deposit with another bank. Now many of you will be concerned or let's say confused here. So why one bank will keep a deposit with another bank? It doesn't make any sense. No, it makes perfect sense. I'll give you an example. There are types of banks which are called as payment banks. Have you heard of payment banks? Let me know. Have you heard of payment banks? Example, Paytm Payment Bank, India Post Payment Bank. These are nothing but payment banks. Now don't start running behind payment banks. We'll discuss it separately. Wait. One of the conditions of the payment bank, one of the conditions of a payment bank is they have to collect the deposits and part of the deposit. How much you'll understand it later, please don't be concerned about it now. Part of the deposit that is collected by the payment bank, they will have to keep with other banks. I'll repeat the statement here. Part of the deposits that is collected by payment bank, they will have to keep with other banks. Is it not an interbank deposit? Is it not a deposit kept by one bank in another bank? Of course, yes. So these deposits are such deposits whichever kept or whichever are deposited by one bank in another bank will be subtracted, will be deducted from gross demand and time liabilities, and you will get net demand and time liabilities. So remember the idea for net demand and time liabilities. I'll use a short form now. NDTL, net demand and time liabilities. Now let me start. Let me start with the two tools here. One is SLR, second one is CRR, cash reserve ratio, statutory liquidity ratio. Understand both of them very carefully. You might feel both are same. No, both are not the same. First and foremost, there is this idea of statutory reserve requirement. Statutory reserve requirement. What do you mean by statutory reserve requirement? These are the reserves which are supposed to be held by the banks. RBI will decide and you will have to follow it. You're a bank, you're supposed to keep these reserves. No questions asked. These are called as statutory reserve requirements. And there are two types of statutory reserve requirement. One is a cash reserve ratio and the second one is statutory liquidity ratio. One is a cash reserve ratio. Second one is statutory liquidity ratio. Now, why does RBI mandate it? Why is RBI telling them, please keep these reserves? Please go back to yesterday's discussion. Where I've discussed this, I'll tell you. We discussed a concept called as fractional reserve system. Yes or no, let me know. In the yesterday's class, we discussed a concept called as the fractional reserve system. And I said while discussing fractional reserve system, if I give you 100 rupees, you're a bank, and there is no requirement of maintaining reserves, you'll simply take it, give it as a loan. But what if the borrower doesn't repay the money? You're taking a lot of risk. You're playing with the money of the depositors. So what RBI does is, it simply tells you, take part of the reserves, hold it. Right? I'll tell you in what way. Please don't worry, I'll tell you that. Right? Hold these reserves. Do not use the reserves in the form of giving loans. You're not allowed, right, to use the reserves to give loans. And that is the basic idea. Now, is it okay if I say that these statutory reserve requirements will protect the interest of the depositors, and also using the statutory reserve requirement, RBI can control how much loans you are creating? Any problem, let me know. Right? RBI is protecting the interest of the depositors. Along with that, RBI is also controlling how much loans you can create, how much credit you can create. Right? So that is the concept of statutory reserve requirement, two types, CRR and SLR. Let me start with the first one, SLR, right? A statutory liquidity ratio. What is the statutory liquidity ratio? It is the percentage of NDTL. It is the percentage of NDTL that the banks are supposed to keep with themselves. Remember this. What is SLR? It is the percentage of NDTL that the banks are supposed to keep with themselves. They are not supposed to give it to anyone. They will keep it with themselves. So what do you mean by this? Imagine there is a customer. Customer has given a deposit of, let's say, 100 crore rupees. 100 crore rupees. Imagine you are that customer. You have 100 crore rupees. You will say, rather than keeping it with myself, you will keep it with the bank. And imagine I am the bank. So you have brought the 100 crore rupees, kept it with the bank. Either SB account, FD account, don't worry about it. Both are deposits only. So you'll keep this 100 crore with the bank. Now what RBI says is, certain percentage of these deposits, let's say 18%. Let's say 18%. Don't mug up the exact numbers. Why? I'll tell you. RBI will change these numbers. It is the power of RBI to change all the numbers. Please don't mug up exact numbers, because by the time you write the exam next year, number could be different. So 18% of the deposits you take, and you'll have to keep it in the form of cash, or in the form of government securities, or in the form of gold. I'll repeat the statement here. Customers will keep deposits with the bank, and RBI says part of the deposits the bank will have to keep with themselves, either in the form of cash, in the form of gold, or in the form of government securities. What kind of government securities? You can keep it in the form of dated securities. You can keep it in the form of dated securities. You can purchase treasury bills. You can purchase state development loans. You can even purchase sovereign gold bond. Don't worry about sovereign gold bond. We'll discuss that when I take a financial market. But dated securities, treasury bills, state development loans, yesterday I've discussed all the three. I've discussed all the three, by the way. So please be very, very careful. So what RBI says is, part of the deposit, you keep it with yourself, either in the form of cash, in the form of gold, or in the form of government securities. Now, despite three options are available, remember this, despite three options being available, the banks will choose G securities. I'll repeat the statement here. Despite the three options being available for a bank, the bank will choose to go with government securities. Why? Imagine you're a bank. Okay, let's start. Imagine you're a bank. You have collected 100 crore rupees as a deposit, right? And let's say 18% is the SLR. You'll keep 18% in the form of cash. Is it a good policy or wrong policy? Answer, you'll have the answer by yourself. Is it good to keep 18 crore rupees in the form of cash only? No, wrong approach. Why? If you keep 18 crore in cash, will the cash get you any returns? Simple. Will the cash get you any returns? No. Right? Don't say, sir, cash we have kept. Right? The cash will lay eggs, and the eggs will hatch. And by after 2 years or after 1 year, when I open this, 18 crores will become 25 crores. No, it will not happen. What about the gold? They can invest in the gold. But there is one problem. The problem is, the gold prices are not stable. Gold prices are not stable in short duration. When you look at the gold prices for, let's say, 5 years, 10 years, generally you see gold prices will increase. But when you see the gold prices on weekly basis, on monthly basis, there is a lot of volatility. There is no stability in the gold prices. Right? So problem with the gold also. And understand this very carefully. You are a bank. Imagine the customer will come to you and ask for money back. Right? Selling gold is slightly difficult. Selling the gold is slightly difficult. Come to the government securities. Can you sell government securities? First question, by the way. Start answering. Can you sell government securities and get the money? Of course, yes. Second, is it less risky? Have you understand this? Is it less risky? Yes, that is also correct. Third one, will you earn interest on the government securities? Rather than selling, if you keep the government securities with yourself, upon maturity, will you earn interest? Of course, yes. So now look at all the three options. You decide where you want to keep the SLR. If you're a rational economist, or let's say rational investor, you'll simply say, sir, government securities is a much better option for me. It is very, very safe. I can sell them if I want money. And right, I will earn interest also. So why choose cash? Why choose gold? I will choose government securities. You remember this? This is how the banks do. And that's the reason. Follow the next point very carefully. Slightly confusing, but first you understand it, it will become a game for you. Slightly confusing. Why? They'll say that SLR, statutory liquidity ratio, is more of a fiscal tool. It is more of a fiscal tool rather than monetary policy tool. I'll explain this, just give me a minute. Right? SLR is more of a fiscal tool rather than monetary policy tool. Why do they say this? What is the reason? Follow the explanation carefully. Now we have established that the banks will purchase a lot of G securities and keep with themselves. Why SLR is there? Now G securities are issued by whom? Follow the next point. G securities are issued by whom? These are issued by Government of India. Why does Government of India issue the G security? Because they want to borrow. All of this we have discussed yesterday. There should not be any confusion. Government of India issues the securities and borrows from the market. For what purpose? For expenditure, for launching a scheme, etc. Now, don't you think when Government of India through budget, right, in the budget they will announce they are going to issue G securities, it is basically related to fiscal policy. I have to understand this. It is related to fiscal policy. Now, some of you will type, sir, what is fiscal policy? Forgetting that we have already discussed the idea of a fiscal policy. Where have I discussed the concept of fiscal policy? The counter-cyclical and pro-cyclical. Fiscal policy refers to what? The decisions of the government related to expenditure and taxation. Have you understand this? Fiscal policy means what? The decisions or the measures are taken by Government of India associated with expenditure and taxation. When government borrows, for what purpose do you think government is borrowing? For expenditure. For expenditure purposes. Government is borrowing for expenses only. Is it not related to fiscal policy then? Is it not related to fiscal policy? Of course, yes. So Government of India issues G securities, which is purchased by the banks. Government is issuing so that they want to borrow. Banks are purchasing because there is a mandate under SLR. So they will simply use a statement, SLR is more of a fiscal policy tool rather than monetary policy tool. Don't be confused here. Please be very clear with these particular concepts. This is the one, statutory liquidity ratio. Let me go to the next one. CRR, cash reserve ratio. CRR, cash reserve ratio. What is the cash reserve ratio? It is a percentage of NDTL that the banks will have to keep with the Reserve Bank of India. It is a percentage of NDTL that the banks will have to keep with Reserve Bank of India. Right? Look at the difference between both SLR and CRR. Don't say, sir, both are one and the same. No, absolutely no. SLR, bank will keep with itself. SLR, they can use that money to invest in G securities. CRR, the bank will keep this money with RBI. Remember this. Let's start with an example. Imagine you are a customer. You have 100 crore rupees. You will deposit this 100 crore rupees with the bank. Now imagine the CRR is 4%, which means the bank has to take aside 4 crore rupees and transfer it to RBI. The bank has to take 4 crore rupees and transfer it to RBI. And next very important point, RBI does not pay any interest on this amount. Remember this. RBI does not pay, understand this, RBI does not pay any interest on this amount. You can simply tell RBI, sir, I've given you 4 crore rupees. RBI says, yes, you have given, but I will not pay any interest on it. Now answer to my question. Simple question, by the way. Between SLR and CRR, both are nothing but the part of the deposits that the bank cannot use it for lending purposes. Between SLR and CRR, which will earn returns to the bank, which will not earn returns. Let's start with the first one, which will earn returns. Which of the types of the tools which is used by RBI will get returns to the banking sector? SLR. Anybody has a doubt here? Let me know. Right? Anybody has a doubt? Let me know. Right? SLR will fetch returns to the bank. What about CRR? Will the bank earn any interest on the CRR? Absolutely no. Remember this. Remember this. You will have to use it later in one more concept. You'll have to use it. Please be very, very careful. Right? Be very careful with these concepts. Somebody said, sir, all these are confusing. No, my dear, these are not confusing. You need to understand the concept. Once you understand the concept, this is just like a game for you. For example, if you have understood SDF, even if the UPSC will ask you the difference between SDF and the bank rate, or let's say SDF and reverse repo rate, you will able to, or you'll be in a position to answer the question very easily. Why? Conceptual clarity is required. Have you understand this? Conceptual clarity is required here. Right? So that is the reason, have a conceptual clarity that basically all these tools are important. Questions have been asked by UPSC. If you understand any question asked by UPSC, you'll be able to answer it. So how? Let me show you a very simple example. Let me give a very simple example. I'll write some points first, then I'll ask you a question. Increase in CRR, reduction in SLR, increase in repo rate, increase in standing deposit facility. This is where some students will get stuck up. Let's see. A, B, C and D. A, B, C and D. Now answer to my question. If RBI wants to promote growth, which of the following tools may be used by RBI? I will repeat the statement here. If RBI wants to promote growth, which of the following tools may be used by RBI? Some of you will say, what about more than one? You can use more than one also. I don't have any problem. But question is very simple. You want to promote growth. Right? So please be very careful here. What is the right answer, sir? What is the right answer? Right answer is option B only. Please don't be confused. It is option B only. Let me explain. First one, point A is clear. Anybody has a problem in option A? I am saying that if RBI wants to promote, sir, you did not create poll. Why are you worried about poll? Answer it directly. No. Right? Always don't follow the mechanism only. Answer it. It doesn't matter. First one, I am saying that point A is wrong. Anybody wants to counter and say, no, sir, I have a confusion in point A. Let me explain. Anybody who has a doubt in point A, who says, no, sir, I think that point A is the correct answer. Right? Sir, understand this. If you increase CRR, we have already discussed this, by the way. You have, let's say, 100 crore rupee deposit, and let's say 4% is the CRR rate now, which means you have 96 crore rupees to lend. Any doubt here? Let me know. Now, if RBI increases this from 4% to 6%, you will have 94 crore rupees to lend. Where do you think loans will be higher? Where do you think interest rate would be lesser? Obviously at 4%. But if RBI increases to 6%, what will happen to rate of interest? Rate of interest increases. Money supply decreases. Will it promote growth or control inflation? This is done in order to control inflation. Right? A is wrong. Reduction in SLR. Apply the same logic. Reduction in SLR. If you reduce SLR from 18% to, let's say, 10%, don't you think the banks will have more money to lend in the market? Have you understand this? I'll repeat the statement here. If you reduce the SLR, right, now the banks will have to keep lesser amount of money in the form of, let's say, G securities. Now the banks will have more money to lend in the market. Right? Of course, yes, reduction in SLR might help in promoting growth. Increase in the repo rate. What is the problem with increasing repo rate? Imagine repo rate is 4%. RBI will increase the repo rate to 6%. What is the impact? Now the bank will borrow from RBI at higher rate of interest, and understand this, they will give loans to you at higher rate of interest. And when they give you a higher rate of interest loan, will you borrow more or borrow lesser? Current affairs. If the RBI gives more rate of interest or at higher rate of interest, the loans, banks will also increase their loan rate of interest. Will you take more loans or lesser loans? Lesser loans. Demand will come down. That will help in controlling inflation, not promotion of growth. And finally, increase in SDF. Increase in SDF. Sir, how come increase in the SDF, that is a standing deposit facility, right, will not be the answer to promote growth? Let me explain this. Understand this carefully. I'll ask a very simple question. Situation 1, if you deposit money, you'll get 4% rate of interest. Situation 2, if you deposit money, you'll get 5% rate of interest. Now, simple question by the way. If you move from situation 1 to situation 2, will you deposit more money or less money? I'll repeat the statement. Situation 1, you have 4% rate of interest. Situation 2, you will get 5% rate of interest. I am saying that from S1, you have moved to S2. Will you increase the deposits that you are keeping or will you reduce the deposit? You will deposit more and more money. It should not be confusing here. You will deposit more money. Why? You are getting more rate of interest. And is it not the same concept of SDF? Is it not the same concept of SDF? Right? Let me know if it is not, if it is a problem. What I explained just now, is it not the same as SDF? If RBI increases SDF, you as a bank, you want to earn more rate of interest, you will deposit more money with RBI. And when you deposit more money with RBI, right, when you keep more deposits with RBI, you have less money. When you have less money, you will, right, give lesser loans. That will help in controlling inflation. I understand. This is how you need to analyze these terms. This is how you need to analyze these particular terminologies. Right? Again, right, if you're feeling it is confusing, it simply means, one, you're not following what is happening in the classroom. You are not, right, focusing on what is NDTL, what is SLR, what is repo, etc. Focus, you'll understand. Let's start. Next, functions of the RBI functions, instruments of credit control. Let me enter into qualitative tools now. Let me enter into qualitative tools. So far, what I've discussed is quantitative tools. And I hope you have discussed. Let me ask a question. Let me see if you have revised it. I will write quantitative here and qualitative here. Quantitative and qualitative. 1 and 2. Right? Focus on the question very carefully. Using which of the two sets of tools? Using which of the two sets of tools will RBI target specific sectors? I will repeat the statement. Using which one of the two sets of tools RBI will target the specific sectors? Thanks a lot. Qualitative. Thanks a lot. Right? And in between that, 4 people, 5 people said 1 quantitative. Means you're not revising. Simple. You're not revising. Because we have discussed this yesterday. In quantitative, RBI will either increase the overall money supply, decrease the overall money supply in the economy. In the overall economy, either increase or decrease. Whereas in qualitative, RBI will regulate money supply, increase or decrease, but targeting specific sectors. They can target certain sectors and regulate the money supply. So how? Let's start. Right, let's start here. There is one more tool that is left out. Just a second. Okay. Right, let's start here. Right, I've written qualitative tools here, but it will start from here only. It will start from here only. Qualitative set of tools. Let's start one by one. Let's understand one by one. What is this qualitative set of tools? There are different types of tools. One is priority sector lending. Second one is variation of margin requirement, regulation of consumer credit, etc. Let's look at all of them. First one, rationing of credit. First one is rationing of credit. Now, before I explain to you what do you mean by rationing, a simple question. It is English question, by the way. Right? Rationing. Rationing means what? Rationing simply means either you can say, sir, allocation or distribution. Allocation or distribution. Right? Rationing means simply that. Let me give a simple example. You come across a shop called as a ration shop. I'm pretty sure you heard of it. Ration shop. Right? What is a ration shop? The shop which is going to distribute food grains to people. The shop which distributes food grains to people. Now let's start. Let's start here. What do you mean by rationing of credit? Rationing of credit is simply nothing but distribution of credit. Allocation of credit. How does RBI control the allocation of the credit? How do they do that? There is a tool used by RBI. The name of the tool is priority sector lending. The name of the tool is priority sector lending. Short form I will use now. PSL. Priority sector lending. And through the tool of priority sector lending, RBI ensures that there is a distribution of credit. Now, before I start the explanation, let me ask a simple question to you. Between giving a loan to agriculture sector and let's say industrial sector, understand my statement very carefully. You are a bank manager. You want to give a loan to agriculture sector as well as industrial sector. Which of the two loans do you think carries a higher risk? 1 and 2. I'll repeat the statement. Between agriculture sector and industrial sector, which of the two does carry higher risk? Remember this, it is agriculture. It is agriculture, right? Many of you do not follow the newspapers. That is the reason this happens. Sir, why? Why do you say agriculture sector is more dangerous to give a loan compared to industries? In industries also they can incur a loss. But please understand the logic here. Please understand. In industries, if you produce the good, there is a market. Have you understand? If you produce a good, there is a market. Right? MRP is decided, etc. But agriculture sector is very much vulnerable. Agriculture sector is too much vulnerable. There are so many factors that can influence the earnings in agriculture sector. So what do you mean by that? What do you mean by that? Very simple example. Monsoon. Very, very simple example. Monsoon. In case of India, right, most of the rainfall that we receive in India comes from monsoon itself. But the problem here is, if the monsoon is very high, production will come down. Any problem? Let me know. If the monsoon is very high, production will come down. If the monsoon is good, right? If the monsoon is good, production is very high. That is also a problem. Sir, why? Why production higher is a problem? If all the production is taken to market, what do you think will happen to market prices? What do you think will happen to market prices? Market prices will crash. Farmers are at the mercy of the market. Third, if the monsoon is very low, then there's a drought. Production is lesser. So don't you think in this particular only example, I'm taking only one example here. If you look at all of this, agriculture sector, the returns, the incomes of the farmers, there is no guarantee there. It is very risky to give loan to an agriculture sector compared to industries. When I talk about this, do not come to a conclusion that I'm saying there is no risk in industrial loans. I am not saying that. All I'm saying is, if you give a loan to industry and a loan to agriculture sector, you are taking more risk by giving loan to agriculture sector. Are you taking a risk by giving loan to industry? Of course, yes. Of course, yes. But the risk that you're taking is comparatively lower. That is the point. Please don't twist my statements and derive something else out of it. So now have a look at this. Imagine you're a bank manager. Will you give loan to agriculture sector? Given a choice, given an option, will you give a loan to agriculture sector? You'll simply say no. You'll say, right, sir, just now we have explained, very risky, I will not give loan. But don't you think agriculture should get access to loans from banks? Don't you think agriculture sector should get access to loans from the bank? Answer is yes, by the way. So how do we ensure that? How does RBI ensure that? There is a tool called as priority sector lending. What is a priority sector lending? I'll start with the definition. I will explain the terms also. Wait for it. Priority sector lending is the percentage of adjusted net bank credit. Now, many of the books, rather than using A and BC, will simply say percentage of loans. Understand my statement? Rather than using the term A and BC, even the newspapers, if you have read, you will know this. They will not use A and BC. Rather, they will straightforward say loans. So, percentage of the A and BC or percentage of loans which are issued by the bank will be given to following sectors. I will repeat the statement of PSL. Priority sector lending refers to percentage of the credit or percentage of the loans which are issued by the bank are reserved for following sectors. What kind of sectors are covered under PSL? We have agriculture sector, educational loan, export credit, micro, small, medium enterprises, weaker sections of the society, startups, affordable housing, etc. There are totally 8 sectors. I've listed some of them here. Have a look at this. I've already listed some of them. Right? Export credit, that is to promote exports. To the exporters, some of the loans are provided. We'll understand that also when I take up international trade. So export credit, startup loans, MSME sector. Again, don't worry about MSME today. Right? It is hardly, I think, around 9th class today. We are yet to cover 16 more classes. We will look at all of them. MSME, educational loans, agriculture loans, etc. Right? So these are the sectors which are covered, and the bank has to ensure that 40% of the loans, 40% of the loans which are issued by them will have to go to the following sectors only. Now follow the next point very carefully. If you are a bank, and let's say you are giving a loan of 100 crore rupees this year, and RBI says 40% of this, you please give it to following sectors. Start answering. Is RBI regulating money supply? First one, is RBI regulating money supply? Of course, yes. And second question, is RBI using a tool targeting specific sectors? Of course, yes. Right? The answer to both the questions is yes, by the way. If RBI increases this from 40% to let's say 50%, then what is RBI trying to tell you? RBI says, I want more and more loans to be given to following sectors. So overall money supply is regulated, and regulation of money supply will also happen in specific sectors. Hence, this is an example of qualitative tool. This is an example of qualitative set of tools, right? You'll have to understand, distinguish with these examples only. Now understand this, there is one more term, A and BC, technical term. You don't have to run behind it, simply understand the concept. A and BC stands for adjusted net bank credit. Now some of you have written A and BC, will ask the long form of A and BC. It is already given here. Adjusted net bank credit. What do you mean by adjusted net bank credit? By the way, definition is given here also. Have a look at it. A and BC refers to the net bank credit plus investments made by banks in non-SLR bonds. What do you mean by this? Imagine here is a bank. This bank has purchased government securities. Simple example. This bank is investing and purchasing government securities. Right? Let's say dated securities. Are these dated securities bonds? Yes or no? Let me know. Are the dated securities bonds? Of course, yes. Second, apart from investing in the government bonds like this, the bank can also invest bonds which are issued by private companies, private sector. Right? Imagine a particular company, XYZ, has issued a bond in the market. Can the bank invest? Of course, yes. They can invest and purchase it. But please understand, these are non-SLR investment. The second example that I gave you, these are non-SLR investments. Why? Under SLR, RBI tells the bank, if you want to invest in a bond, these have to be government securities only. But apart from this, if you invest and purchase the private sector corporate bond, I will simply count it as non-SLR bond or non-SLR investment. Right? Any doubts in understanding this? Again, don't say, sir, SLR, what is SLR? We have discussed it 10 minutes ago. We have discussed the SLR concept 10 minutes ago. So under SLR, you will invest and purchase G securities. But if you invest and purchase the private sector bonds, the bonds issued by the private sector company, these are called as non-SLR investment. So when you say A and BC, you will count the credit, that is the loan issued by the bank, plus non-SLR investments done by the bank. That is adjusted net bank credit. So what is the definition? Definition is given here itself. It is there in the slide only. A and BC counts, or A and BC is the loans given by the bank plus any non-SLR investments done by the bank in the bonds sector. Done. Let me go to the next one. Regulation of consumer credit. Now, what do you mean by regulation of consumer credit? Let's start with a simple example. You have to answer the question, so then you'll understand what is being discussed here. Otherwise, if you keep on looking at it, do not participate, no way. I can give you a definition, I can give you a picture. If you don't analyze it, you will not be getting it. Let me ask you a very simple question. Imagine your salary is 1 lakh rupees. You want to take a loan. There is bank one which will give you a loan and say, sir, monthly, you'll have to pay us, let's say 20,000 rupees. Understand this very carefully. You want to take a loan, your salary is 1 lakh rupees. Bank says, okay, sir, I will give you a loan, but you'll have to repay it. How can you repay it? Monthly, you'll have to pay 20,000 rupees to me. Another bank says, sir, yes, I will also give you a loan. But I want you to pay 50,000 rupees every month. Sir, why 50,000? Repayment. Now follow this very carefully. Answer to my question. If your salary is 1 lakh, you don't want to pay a lot of it in the form of repayment of the loan. From which of the banks you will take a loan? Like obviously, if you're concerned about other expenses, you'll say, sir, apart from this, I need to take care of my parents also. I need to take care of my children's education. And spouse is also there. food grains I need to purchase. So I need some money. So if I give every month 50,000 to a bank, that becomes a burden for me. That is a huge burden. And next, the second question. Follow the second question carefully. Imagine there is no offer from bank B1. There is no offer from bank B1. There is no option available. B1 is not available. Only B2 is available to you. Right? Only B2 is available. B1 is not available. Now in the overall economy, apart from you I'm talking, will the people take more loans or lesser loans? Have you understand this? Right? B1 is not available. B2 is available. Don't only look at yourself and say, sir, doesn't matter, I'll take it. But look at overall economy. In the overall economy, if this is the option, what will happen to the number of loans taken? Number of loans taken obviously will come down. Apply the same logic here. Apply the same logic. Regulation of consumer credit. RBI looks at the current situation and realizes that demand is higher in the market. And RBI says demand for four-wheelers, 4W is four-wheelers, is higher. People are taking loans and purchasing four-wheelers. Demand for two-wheelers is higher. People are taking loans, purchasing two-wheelers. Demand for housing, that is real estate, is also higher because people are taking loans and purchasing houses. Now, if this is a situation that is present in the market, can I simply say that there is always a concern of inflation? Yes or no? Let me know. There is always a concern of inflation. And RBI is concerned about it. So what RBI will tell the banks is very simple. You are giving a lot of loans, and right now you are giving the loans where the EMI simply stands for equated monthly installments. EMI, equated monthly installment. Right, sir, what is EMI? How it is calculated? Don't become a manager here, not required. So when you take a loan, you'll have to pay or you'll have to give certain amount monthly to the bank. That is EMI. Now look at this situation. RBI is telling the banks, your EMI component is very less. You are giving a lot of loans because your EMI is lesser. Rather than giving loans with the EMI of 20,000, increase the EMI to 50,000 rupees. Have you understand this? Rather than giving loans with the EMI of 20,000, don't give them. Increase the EMI to 50,000 rupees. Now tell me, simple question by the way. Now tell me, if the banks start providing the loans where they are increasing the EMI component, what will happen to loans in the market? What will happen to loans? Will the people take more or less loans? The people will start taking lesser loans. If the loans are reducing, what will happen to demand? What will happen to demand in the market? Demand will come down. If the demand comes down, what will happen to dangers of inflation, concerns of inflation? We will be able to control the demand, reduce the impact of inflation. Does it make sense to you? If there's a problem, let me know. So can we use it vice versa? Can we use it vice versa? For example, imagine RBI wants to promote growth now. Imagine RBI wants to promote growth. How can they do that? Right now the banks are offering a loan product at 50,000 rupees. Don't simply say problem. Tell me where is the problem. If you say, is there a problem? Yes, a problem. Great. But where? Just follow it. Right? You'll have to tell me where is the problem. If you simply say, nothing is clear. From where do I start? From the first class. What is economics? So please be very clear in your doubts also. Don't simply say problem, sir. Not understanding. Confusion, sir. Where is the confusion? Let me know. Only then I can explain. Okay, so understand this. Imagine RBI wants to promote growth now. And when RBI wants to promote growth, right now the loans which are being offered, EMI is 50,000. RBI will tell the banks, reduce the EMI component. From 50,000 rupees, reduce the EMI component to let's say 30,000, 20,000, etc. Now when the EMI component will come down, what will happen to loans taken in the economy? People will take more loans. When they take more loans, what will happen to demand? Demand increases. And when the demand increases, what will happen to production? Increases. That will promote growth. So understand the logic here. RBI can use this tool to ask the banks, rather than asking to direct to the banks, to change their consumer credit. Consumer credit means what kind of loans are we giving for consumers? Simple. What kind of loans are we giving for consumers? Who are consumers here? I am a consumer. You are a consumer. Your parents are consumers. So what kind of loans are giving? The banks are giving to consumers. That credit will be utilized. We'll change the policies there so that either the demand for such loans will increase or the demand for such loans will decrease. Now, second point, very important point. I'll just reiterate it. You don't have to apply it every time. Follow this very carefully. Using this tool, is RBI regulating money supply? Yes or no? Let's start. Right? Using this particular tool, is RBI regulating money supply? Of course, yes. Is RBI regulating money supply in specific sectors? Of course, yes. Qualitative tool. Hence, qualitative tool. Next one, variation of margin requirements. Variation of margin requirements. Right? What do you mean by this? Margin simply refers to, understand this, margin simply refers to the difference between loan and the security. I'll explain this. Follow this carefully. Margin simply refers to the difference between the value of loan and the security or collateral that we have provided. Let me take a very simple example. Don't get into the technicalities. Understand the logic. If you don't trust me, open the book, any reference book that you have, just to see they will give one statement regarding this. Just one statement. And they will move on. Why you don't have to become managers here? Not at all required. Let me start. Imagine you'll approach a bank. Okay? Right? Imagine you'll approach a bank and you'll say, sir, I want to take a housing loan. And you'll say, sir, I want to take a housing loan. And the bank says, okay, sir, I'm willing to provide the loan. How much loan you want? How much loan you want? And the borrower simply says, sir, I want a loan of 1 crore rupees. I want a loan of 1 crore rupees. Now, bank will simply say, okay, sir, I will give you a loan of 1 crore. But if I'm giving a loan of 1 crore rupees, I need to collect a certain security from you. Why? What if you don't repay the loan? Simple logic. I will give you 1 crore. But what if you don't repay the loan? What will I do then? That is the reason what the bank says is, if you want to take a loan of 1 crore, please provide me a security whose value is, let's say, 1.2 crore rupees. It could be your house only. It could be a land that you are owning, whatever it is. Give me a security whose value is 1.2 crore rupees. Now, many of you simply say, now you get too technical and say, sir, imagine I will give a paper to them. Documents, land documents. How will they come to know that the value of the land is 1.2 crore? Understand this carefully. The process of giving loan is not done in 1 hour. It is not even done in 1 day. It will take multiple days, multiple weeks, in fact. Why? You can simply provide a document of a house or let's say a land that you own. Now the bank has to first go to the land, check the land is there or not, house is there or not, and get the valuation done. Again, don't run behind the process, not at all required. But understand the process very carefully. You want to take a loan of 1 crore rupees. they will ask you for a security or collateral whose value is, let's say, 1.2 crore rupees. Now, this is situation 1. This is situation 1. And what is the margin here? What is the margin? The difference between the loan value and the value of the security. I'll repeat the statement. Margin is the difference between value of the loan and value of the security. Right? 20 lakh rupees or 0.2 crore rupees. That is the margin. Let me go to situation 2. Situation 2. Now, you'll go to a bank. You'll apply for a loan. Now, bank says you want a loan of 1 crore rupees. The margin should be 0.4 crore rupees. The margin should be 40 lakh rupees, which means you'll have to provide a collateral or a security whose value is 1.4 crore rupees. Now, follow this very carefully. Follow this very carefully. If the margin is increased like this, what will happen to people taking loans? Will people take more loans or less loans? Let me know. Let me know. Right? Simple logic, by the way. If the margin is changed from 20 lakh to 40 lakh rupees, right? People will take lesser loans. Why? Many of the people will not be able to provide this kind of a collateral. So the amount of loans will come down. The demand in the market automatically comes down. Can we do vice versa? Can we do it vice versa? Of course, yes. Imagine the margin right now is 40 lakh rupees. Imagine the margin right now is 40 lakh rupees. The margin will be reduced to 20 lakh rupees. Start answering. What will happen to the loans taken by the people? Will more and more loans be taken or lesser loans? People will take more loans. Why? Margin has come down. More people will be able to afford the margin. They will take loans. Now, is it okay if I say RBI can use this tool to regulate money supply in specific sector only? It can be done for real estate. It can be done for, right, let's say that segment, or let's say four-wheeler loan, two-wheeler loan, etc. As per the requirement. This is a variation of margin requirement, right? That is basically the idea of the tool. Let me go to the next couple of the tools. Not very important, but you'll have to understand. One is a direct action. Second one is moral suasion. One is a direct action. Second one is moral suasion. Let me start with the latter one, moral suasion. Right? What do you mean by moral suasion? Moral suasion simply refers to RBI directing or asking the banks to cooperate and implement the policies. Right? I've given the definition, by the way. RBI has many policies. RBI has a PSL. RBI has a margin requirements. RBI has a repo, reverse repo, etc. Many policies are there of RBI. Now, what do you mean by moral suasion? Imagine you're RBI and I'm one bank. I'm not following your policies. I'm not implementing these policies correctly. So what you will do is either you will send a letter to me or you will write a very big paper and warn that these banks are not following. You'll give a statement when you're conducting, let's say, a press conference that such a bank is not following the policy. Or in a meeting, you'll warn me. You'll basically point me out and say, you are not following the credit policies. This is called as a moral suasion. This is referred to as moral suasion. What is the whole idea here? RBI either will, right, prod you or basically will say, right, why are you doing this? Please don't do. I have implemented a policy. You are not following. What is the problem? Please follow. Or else the tone will change. RBI now will simply ask you, why are you not following? Right? Why are you not following? I will send a notice to you. So either through threat or through, right, casual, either through threat or through consoling, RBI wants you to follow the guidelines. That's it. That is the basic idea of moral suasion. That is the basic idea of moral suasion. Next, direct action. Now imagine you're the RBI. You have already warned me. I'm not following guidelines. You have sent a notice to me. I'm still not following. What is the next option available? What else can you do? Now you will take direct action. If you don't trust me, please look at what kind of RBI has taken, what kind of action RBI has taken regarding many banks in the last 1 year. Every week you come across this article which says RBI imposes a penalty of 2 crore rupees on a bank. RBI imposes heavy penalty of 5 crore rupees on this particular bank. RBI imposes sanctions on this particular person. What is the meaning? RBI earlier has tried these particular methods, that is a moral suasion. Even then it is not working out. RBI will simply impose penalties. Right? Is the penalty the only factor? No. RBI can simply tell a bank, have a look at this. Imagine there is a bank B1. It is not following the policies of RBI. Despite warning, they are not following. Now they want to borrow from Reserve Bank of India. They want to take a loan from Reserve Bank of India. RBI says, to rest of the banks, I will charge 4%. But because you are not following my guidelines, I will charge you 5%. Is it also fine? Is it also penalty? Of course, yes. You keep on borrowing from RBI, but now you'll have to pay higher rate of interest because that is a direct action by RBI. Now, lastly, the concept of publicity. The last concept of publicity. Let me start with a statement, then I'll give an example. You will understand. To promote an effective public opinion for policy implementation. What is the publicity? Publicity is to promote a public opinion so that the bank will implement the policies. So what do you mean by that? What do you mean by that? Let me give a very, very simple example. Imagine you have a 100 rupee note. By mistake, right? You put it in your back pocket, or let's say, right, in the purse, and you have left the purse, or let's say the note itself, currency note itself, in the pant or the t-shirt that you're wearing, and you put it in the washing machine. Now, what the washing machine will do? Obviously, it's duty. It will wash everything along with your clothes, right? Even the currency note will be washed. But understand, it's a genuine currency note. It's not a fake. It is a genuine currency note. But because you put it in the washing machine, it has become crumpled or crumpled like this, right? Some of the words are missing. There is a problem. So what do you need to do with that particular currency note now? You want to give it to somebody else. You'll come to the shop. I'm the shop owner. You'll try to push it to me. I will simply say, no, sir, it is not acceptable. See, number is not visible. See, this is not there, etc. I will say. What RBI says? You must have seen the ads. RBI कहता है, right? I'm pretty sure you must have seen the ads. RBI कहता है, right? You can take this currency note, go to the bank, get it exchanged. Very simple, right? You can take this currency note, go to the bank, get it exchanged. How do I know this information? How do you know this information? Have you seen advertisements done by cricketers? Have you seen advertisements done by Mr. Amitabh Bachchan? I'm pretty sure all of you have seen it. If you're watching a match, right now, no point of watching a match also for next couple of days. Right? If you're watching a match or you're watching KBC, you're watching, right, a movie, suddenly in between the break will be there, and Mr. Amitabh Bachchan will come and say, RBI कहता है, जानकार रहिए, सतर्क रहिए, etc. like this. What is the importance of all of it? What is the importance? Importance is simple. The RBI through advertisements is trying to convey a message to you. They're trying to educate you. If you are educated as a customer, if you are educated, what is the next outcome? You will expect the bank to implement the policies. Does it make any sense to you? If you are educated, you expect the bank to implement such policies. If you take this particular soiled note and you go to a bank, the bank manager cannot say, no, I will not exchange it. He has to exchange or she has to get it exchanged. There is no option available because it's a RBI policy. So what they're doing is basically through publicity, through advertisements, they're creating a public opinion so that you will know that what is supposed to be done by the bank, what kind of services they're supposed to provide to you, right? That is the basic idea of publicity, right? So these are the various quantitative and qualitative set of tools. Now the next one is measurement of money supply or monetary aggregates, right? Measurement of money supply or monetary aggregates, right? What do you mean by money supply or monetary aggregates? Money supply simply refers to how much money is there with the people in the economy. Understand this carefully. What do you mean by money supply? At this point of time, right now, how much money is there with all of us? That is called as money supply. Simple, right? So what is the definition? I'm telling you the definition only. Money supply simply means at a point of time, right now, how much money is there with all of us? But please understand, the money that I'm talking about here can be in the form of cash. Let me know if there's a problem here. Can be in the form of cash or can be in the form of deposits. Right? I'll repeat it. The money that is there with the people, that is with me, you, somebody else, etc., are based calculating how much money is there. But this particular money, I have to understand this. This particular money is present in the economy either in the form of, right, in the form of cash with us or in the form of deposits. So what do you mean by this? Imagine you earn a salary. I'll take a very simple example so that you understand it. Imagine I'm a Manrega worker. Manrega worker. I've earned this particular wages. Right? Don't say only 20 rupees, sir. You are so poor, etc. Yes, right. That is a fact. So let's start. Imagine I'm a Manrega worker. I've worked today and I got this particular amount of 20 rupees. Now what RBI wants to do is RBI wants to calculate how much money is there with all of us. But is it okay if I say this? Is it okay if I say this? This 20 rupees, I can keep it with myself in the form of cash. Right? Any doubt? Let me know. I can keep this 20 rupees in the form of cash with myself, or else I can take this 20 rupees, put it in the form of deposit in a bank. That is also money, by the way. I can take this 20 rupees, put the 20 rupees in the form of a bank deposit. So which deposit? Current account? Maybe. Savings bank account? Maybe. Fixed deposit? Maybe. Doesn't matter which deposit, that is not a concern. But that is also money. Any problem in understanding this, let me know. Right? Because the money supply, RBI needs to identify it. And I'll explain to you why these are very important. And that is very important for you people. Why? Let me give a very simple example. RBI wants to increase money supply. If you are the RBI governor, don't you want to find out how much money supply is already there in the market? If you are the RBI governor, right, you want to increase the money supply, before you do that, don't you want to find out how much is the money supply in the first place in the economy? That is very important. You should be able to find out. So that is what RBI does here. So there are 5 types of measurements. There are 5 types we are measuring the money supply. Right, so understand this? So is bond coming under money supply? No, my dear. I have clearly told you. Money supply basically is counted like this. Either the cash that you're holding with yourself or the deposits you're keeping with the bank. Sir, why? Why like this? RBI says, I want to measure the money supply so that I want to understand if I increase money supply, will the demand increase? Will it cause more inflation, etc.? I want to measure that. I want to find out that. Or if I increase money supply, will it contribute to growth? I want to measure that. That is the reason RBI simply measures the money supply under 5 different methods. Follow these very carefully. One by one we will go. M0, M1, M2, M3 and M4. 5 measures. Right? M0, M1, M2, M3 and M4. Out of these 5 that I have given here, I can divide all the 5 into 3 groups. Out of all the 5, I can divide them into 3 groups. What are the 3 groups? M0 is 1 individual. M1 and M2 is 1 group. And M3 and M4 is another group. We'll understand one by one. But I can divide M0 into 1 part. M1 and M2 I can club them. M3 and M4 I can club them. M0 is referred to as monetary base. Remember the terminologies can be asked by UPSC. M0 is referred to as monetary base. It is also referred to as high powered money. Why wait? We will understand all of it one by one. It is also referred to as high powered money. M1 and M2 it is called as a narrow money. M3 and M4 it is referred to as broad money. All these terminologies are important. Remember them. Remember them. M0, right? It is monetary base or high powered money. M1 and M2 narrow money. M3 and M4 broad money. Now, on what basis we call them like this? Why do we call M3 as a broad money? Why do we call M1 as a narrow money? We'll understand it. Just give me some time. You have to give me some time. Before that, do you remember this particular picture? Yes or no? Let me know. Do you remember this particular picture? Right, sir, we have used it already, by the way. We have used it. Where? To understand the concept of fractional reserve system. To understand the idea of commercial bank money as well as the fractional reserve system. Let's start. Let's start. Right, the idea here is, sir, why are you revising it? Simple. Imagine RBI has printed 100 rupee note. Students are getting confused in this context to understand this. Imagine RBI is printing 100 rupee note. Now, how do you think that 100 rupee note will come into circulation? Let me see. RBI has printed 100 rupee note. How do you think that 100 rupee note will come into circulation? It will come through banking sector. RBI doesn't deal with me and you. RBI doesn't deal with industries directly. Absolutely a big no. RBI will deal with the banks and the banks will give loans to us. But understand this very carefully. Whenever RBI has printed, let's say, a 100 rupee note, whenever RBI has printed a 100 rupee note and wants to supply this 100 rupee note in the market to a bank, bank will provide a security. Bank will provide collateral. So why are you saying like this? Let me give a very simple example. Don't worry about it. Look at the next example very carefully. You will come to a shop. Imagine you will come to a shop. You want to purchase the bottle. Can I simply say that transactions will happen in 2 directions? One, I will give you the bottle. Second, you will have to give me money. Any doubts? Let me know. Any doubts? Let me know. Right? I have manufactured it. I'm selling this particular bottle to you. First step is I will give you the bottle. Second step is you will have to give me money. Apply the same thing here. Apply the same thing here. Here is Reserve Bank of India. It has produced the product. If you understand this, 100 rupee, I'm referring to it as a product. RBI has produced the product. Now they want to give it in the market. So they will give it to a bank. In return, they will collect a security. Is it okay? Any problems in understanding? Let me know. RBI will give a product and in return will collect something from a bank. Now understand this carefully. Next point is important. You will get stuck up there itself. You have, imagine you are the person. Right? Let me go with the same example. Right? First step is what? I gave you this bottle and I collected money from you. Now immediately you feel, no sir, I don't want to purchase the bottle. What you will do is, you will hand over the bottle to me. I will hand over the money to you. If you understand the second step also. First step is simple. I will give you the bottle. You will give me the money. Immediately you feel, no, that is not required. You don't want to purchase the bottle. So you say, wait. I don't want to take it. So please take your bottle back. Give my money back. Right? Second step of the transaction. So understand this carefully. In the step one, RBI has given 100 rupee to the bank, collected security from the bank. In the step two, here is a bank. The bank will go to RBI and say, take your rupee back. Take your rupee back. Give me back my securities. Give me back my securities. Right? This is the second step. Now look at the step 1 and step 2. I will use a statement. Don't be confused. Look at step 1 and step 2. Is it okay if I say that this 100 rupees is a liability for RBI? Now the doubts will start. But again, before you ask me a doubt, look at step 1 and step 2. Is it okay if I say this 100 rupee that has been printed by RBI is a liability for RBI? If you have a doubt, let me know. If you have a doubt, let me know. Because many of you, like, put yourself there. You have 20 rupees. You will say, sir, but 20 rupees is an asset for me. Don't think like that. Don't think like that. Look at what is happening. In the step 1, bank is giving security to you. You have given 100 rupee. You have given this 100 rupee that is printed. The 100 rupee note you have given. In the step 2, the bank says, I don't want your 100 rupee, take it back. Take it back and give me back my security. So that 100 rupee becomes a liability. The printing of 100 rupee becomes a liability for Reserve Bank of India. So very difficult to understand. Then simply mug it up. My recommendation is simply mug it up. Those who are saying it is an asset, you are looking at a different calculation altogether. Right? Simply mug it. Right? The notes which are printed by RBI is nothing but a liability for RBI. It is a liability for RBI. Let me try to give you one more example so that you understand. If RBI has printed 100 rupee note, you have it. What does it mean? What does it mean? You can use the 100 rupee to purchase 100 rupee worth of goods and services. Is it okay? The 100 rupee that you're having, you can use it to purchase, right? To purchase 100 rupee worth of goods and services. Now look at this very carefully. Imagine you are going on a walk or a jog and Mr. Shaktikanta Das is also walking in the same park. You will go to Mr. RBI Governor. You will give him 100 rupee. What should be the RBI's duty now? What should RBI Governor do? RBI Governor is supposed to provide you with 100 rupee worth of goods like this. RBI Governor is supposed to give you equivalent value of 100 rupee note. So that is the reason we simply say the currency notes printed by RBI. Follow the complete statement. Do not twist it. Do not misunderstand it. Full statement is this. The currency note printed by RBI is the liability for RBI. I will repeat the statement. The currency note, right? Currency note printed by RBI is the liability for RBI. I'm not talking about you. I'm talking about RBI. Your argument is, sir, I have 20 rupees. It is an asset for me. RBI is not using it. RBI is not using it to purchase goods in the market. So RBI's currency notes are liability for RBI. Right? Difficult to understand. You don't have to understand it. Not at all required for UPSC. Simply by heart it. When I say mug up, many of you will simply ask me, sir, what do you mean by the term mug up? Despite doing this throughout our life, you will ask me, sir, what do you mean by mug up? By heart. By heart. Right, sir, what do you mean by heart? Like you do for your university exam. Early morning, you will wake up and you'll sit and start doing like this. Right? RBI does this, RBI does that. That is what I meant. Right? So again, don't ask, sir, it is relevant for UPSC. No, it is not relevant. Right? Because I've written it, some people will by heart the term also. Not at all relevant. Right? So understand the logic here. Whenever RBI prints a currency note, it cannot willy-nilly use it. RBI cannot use it to purchase, let's say, fruits in the market. RBI cannot use it to purchase a car. If RBI does that, that is an asset. But is RBI doing it? No. What RBI does is, it will purchase certain securities from the bank and give 100 rupee. And if the bank returns the 100 rupee, RBI has to give back the G securities. Hence, the currency note becomes a liability for RBI. Done? Okay. Right. So this is the discussion here. Let's take a break. Right. Let's take a break. After the break, we'll start from this. Go back to M0, M1, M2, M3, and M4. Let's try and understand all those particular concepts. Okay. So let's take a break. Before the break, let me take up certain questions from your side. So whether SDF makes RRR useless? Useless. That is the reason I said that, sir, some definition from RBI document directly. I have taken this definition. What is the difference between live classes? You should not be asking these kind of questions. My dear, please don't ask these kind of questions. In a recorded class, I cannot answer. Not otherwise. Again, why are you twisting? If you don't have the same habit even in the UPSC exams. Anyways, you want 10 minutes? I will not lose anything. Let's take 10 minutes. 8 to 10. Let's start at 8:10. Right? Okay, let's start. Welcome back. Am I audible to you people? Before I start, am I audible to you people? If I'm audible, I'll start then. Great. Let's start. So idea of commercial bank money we have discussed. What do you mean by commercial bank money? The credit creation. Simple. It's the process of credit creation. So what do you mean by credit creation? Loans are created. I repeat, loans are created. Right? The bank doesn't print money. Bank merely takes the money issued by RBI, circulates it in the form of loans in the market. That is called as a credit creation. Yesterday we have discussed. Now let's start with a very simple example. Imagine RBI has printed 100 rupee. RBI has printed 100 rupee and you have the 100 rupee now. Let's start with the first step here. You have 100 rupee. You will take the 100 rupee, deposit this in the bank 1. Now what the bank 1 will do is, imagine the reserve ratio is let's say 10%, CRR, SLR, etc. They will keep aside 10 rupee and use the remaining 90 rupee to lend to company A. Company A will purchase something from B. Now B will have this 90 rupees. What the B will do is, B will take the 90 rupees, deposit this in the second bank. Now the second bank will keep aside 9 rupees, that is a 10% of it. Use the remaining 81 rupees to lend to company C. Now the company C will purchase a machine, let's say from company D. Company D will have 81 rupees. The D will submit this or deposit this in the bank 3. Bank 3 will keep aside 10% of it. The reminder, that is 72.9% of it, right, will be issued in the form of loan. Okay, right? This will be issued again in the form of loan. Now let me ask a very simple question. Will the process continue or stop like this? Right? Let me guess. Right? Let me get what you're understanding from here. Will the process continue after this step, or it will simply stop in the economy? Of course, it will continue. Meaning what? What I'm trying to say here is, the process of credit creation is done by the banks. They'll keep on creating credit in the market. It will not stop. So why it will not stop? Imagine you go to a shop, purchase a 10 rupees worth of good. The shopkeeper will take the 10, put it in the form of deposit in a bank. So bank has got money, they will circulate it again. So credit creation is a continuous process. It will keep on happening. Right? It will keep on happening in the system. But please understand, there's a term called as a money multiplier. There's a term called as money multiplier. RBI uses a term called as money multiplier. What do you mean by money multiplier? Money multiplier simply refers to a system wherein the introduction of new money, understand this very carefully, the introduction of new money in the system will lead to creation of how much total money supply. I will repeat the statement here. What do you mean by money multiplier? If you introduce a new money, what do you mean by new money here? This money was not there in the circulation, but now it has been introduced. So if you introduce a new money, as a result of this, there is an increase in the total money supply. Any problem, let me know. Right? If you increase the money supply, that is first point. If RBI prints money and supplies it, that will result in the increased money supply in the economy. Now, how do you understand if I introduce 100 rupee, what is the total increase in the money supply? That is called as a money multiplier. I'll repeat the statement here. If RBI prints 100 rupees, supplies it to economy, right? That 100 rupee will come into the system. As a result of this 100 rupee, because of the banking sector being involved, how much is the change in the total money supply? But how many times the money supply will increase in the economy? Right? Let me prove it to you. RBI has printed only one currency note. Imagine this is the only currency note in India. 100 rupee is the only currency note. Now, please don't ask me, sir, if 100 is a currency note, how can you divide 8.1, etc.? Moot point, right? Not relevant, not required also. Focus on the concept here. Imagine RBI has printed 100 rupee currency note, supplied that in the economy. The banks are creating loans. The banks are creating loans in the economy. And when banks will keep on creating loans, money will fall again into the banking sector in the form of deposits. Yes or no? Right? I'll repeat it again. The banks are creating loans. As a result of creation of loans, money is falling into bank again, coming into bank again in the form of deposits. Now, is it okay if I say that if the money keeps on getting circulated like this, money supply in the economy will increase? What is the money supply? Total amount of a cash that is there with us, and the total amount of deposits that is there in the banking sector. So because the banks are involved in circulation, fractional reserve system, the deposits in the banking sector will increase, cash held by the public will increase. As a result of this, total money supply economy will increase. Total money supply in the economy will increase. You need to understand this. Right? Simple logic. Now, apart from this, rather than RBI printing money, let me ask you one more question here. Rather than RBI printing money and supplying the money, which will lead to increase in the total money supply, can the total money supply in the economy also increase if I reduce the CRR? Let's see this. Right? Start answering. Let's check it. Rather than simply RBI printing the money and giving it to you, which gets circulated, if RBI reduces CRR, if RBI reduces SLR, will the total money supply in the economy increase? Answer is yes. Those who are saying no, let me know what is your argument. I will tell you what is the right argument. Answer is yes, by the way. Sir, how? How reducing CRR will increase the money supply? How reducing SLR will increase the money supply? Already we have discussed, you need to apply it. Right? You need to apply the logic. So have a look at this. Imagine there is a bank. The bank will collect a deposit of, let's say, 100 crore rupees. Out of it, let's say 4% is the CRR, which means at 4% CRR, the bank will have to keep 4 crore with RBI. And remaining 96 crore rupees, the bank can use it to lend. Again, don't say, sir, SLR is there. Yes, it is there. Let's not complicate it. Let's not complicate the things. Let's start with the simple things. So you have 96 crore rupees to lend. Now, if RBI reduces this from 4% to 1%, if RBI reduces this from 4% to 1%, what is the outcome? You keep only 1 crore with RBI. Now you have 99 crore rupees to lend. Now, between this, that is situation 1 to situation 2, what has happened? Between situation 1 to situation 2, what has happened? In situation 1, you did not have 4 crore rupees to lend in the market. In situation 2, now you have extra 3 crore rupees. Is it okay? In situation 2, you have extra 3 crore rupees. So the money that was not there for circulation earlier is available. The money that was not available for circulation is available. What will the bank do? Issue loan. And if they issue in the form of loan, right? If they issue in the form of loan, what do you think will happen? What is the next step? The next is simple. Again, it will come back to the bank. Again, loan. Again, it will come back to the bank. Again, loan. So that is the argument. Right? You've discussed all of it. Apply. Think analytically. That is my suggestion to you people. Think analytically. You will understand the answer there itself. So if RBI reduces CRR, will the money supply, total money supply in the economy? Understand this. If RBI reduces CRR, will the total money supply increase? Of course, yes. If RBI reduces SLR, yes. Now, is it okay if I say this? Is it okay if I say this? If RBI wants to control inflation, reduce the total money supply, RBI will increase CRR, RBI will increase SLR. Vice versa. Right? That is the basic idea. That is the basic idea. Now, what is this money multiplier? What is this money multiplier? A new money which was not earlier there for circulation, it is available. Now, as a result of this new money which is available, how much is the increase in the total money supply in the economy? I'll repeat the statement. As a result of this particular new money being available, what is the increase in the total money supply in the economy? For example, let me go back to this table. Let me go back to this particular table. How much money has been introduced? How much is the new money which is introduced? The new money introduced is 100 rupees. Any doubts here? The new money introduced is 100. Until now, this 100 rupee was not there. This has been introduced in the system. Now have a look at this. As a result of this 100 rupee, what is the total money circulation? What is the total money available in the market? Bank 1 has a deposit of 100. Bank 2 has a deposit of 90 plus 9, 99 rupees here. Bank 3 has a deposit of 81 plus, Bank 3 has a deposit of 81. Bank 2 has a deposit of 90. Bank 1 has a deposit of 100. Don't you think the money supply in the economy has increased? Don't you think the money supply in the economy has increased? Of course, yes. But now I need to find out. Follow this next point very carefully. Now I need to find out, as a result of this 100 rupee, how much is the total increase in the money supply? Right? As a result of this 100 rupee, right, by the way, you already answered it. This process will not stop here. The process will continue. So now you need to find out, if the process continues, how much is the total money supply if you introduce 100 rupee in the market. Understand this very carefully. For this, RBI uses a concept called as money multiplier. What is a money multiplier? Remember this. Money multiplier, I use a short form now. Money multiplier is equal to MM. That is equal to 1 upon reserve ratio. This is one way RBI calculates money multiplier. That the money multiplier is equal to 1 upon reserve ratio. Now some of you are calculating the amount in the table. Please don't do that. Why? After this step also, it will continue. I have to understand this. After this step also, the process will continue. The next bank will receive 72.9 rupees. They will keep aside 7 rupee 29 paise, issue the remaining amount in the form of loan. So process will continue. Don't calculate. Not required. I will tell you how you want to, or what is the calculation. So the money multiplier is equal to 1 upon reserve ratio. If you remember it earlier, the table that I have taken, what is the reserve ratio? Right? Let me check whether I have observed the table or not. What is the reserve ratio I have taken in the table that I used some time ago? I have used the reserve ratio of 10%, by the way. 10%. Now use the formula. Money multiplier is equal to 1 upon 10%. Right? Simple mathematical calculation. 1 upon 10% is equal to 1 divided by 10 divided by 100. Transfer this 100 to the top. 100 divided by 10. Cancel. Money multiplier will be 10 times. Right? Money multiplier will be 10 times. So what do you mean by money multiplier being 10 times? Simple. If RBI will print 100 rupee and supply it in the economy. I'll repeat the statement here. Right? RBI will print 100 rupee and supply it in the market. If the money multiplier is 10 times, the total money supply will increase by 1000 rupees. I will repeat the statement here. What is the meaning? What is the meaning of money multiplier? Imagine the money multiplier is equal to 10 times. It simply means if RBI will print 100 rupee and supply it to the economy, the money supply in the economy will increase by 10 times of this money. That is 1000 rupees. So what if I get a money multiplier is equal to 4 times? It simply means if RBI prints 100 rupees and supplies it to the market, the total money supply in the economy will change by 400 rupees. Is it okay? That is a simple logic here. Right, sir, what about CRR? Imagine RBI reduces CRR. Right, let me apply even CRR here. Imagine RBI reduces CRR. And as a result of this, banks will have, let's say, 1000 rupees now. Simple logic. Right? As a result of the reduction in the CRR, banks now will have additional 1000 rupees to lend. If the money multiplier is 10 times, then what is the total increase in the money supply? It will be 10,000 rupees. It will be 10,000. Maximum increase is 10,000. Because understand the logic here. Understand the logic. What we have discussed in the table is, if A will get 90 rupees, A will purchase raw material from B at 90 rupees. And we assume that B will take all the 90 rupees, put it in the bank. But rather than that, can B keep 10 rupees in the form of cash only? I have to understand this. Can B keep 10 rupees in the form of cash, deposit 80 rupees into the bank? Of course, yes. That can also happen. So that is the reason. Understand the reason carefully here. We have assumed that whatever money is received by the people or companies, etc., they will deposit all of it into the bank. But it is not necessary that they do it. They can keep a part of it in the form of cash. Remaining, they will keep it in the form of deposit with the bank. And if remaining comes, for example, first step, B has received 90 rupees. Out of 90 rupees, let's say, B will keep 10 rupees, right, with himself or herself. Remaining 80 rupees, they will deposit in the bank. Now only 80 rupees gets circulated again in the form of loan. What about 10 rupees? I will simply say this is cash held by the public. This is cash held by the public. So that is the reason, understand this carefully. When I say money multiplier is 10 times, the statement is, if the banks are getting 1000 rupees, the maximum amount, the maximum level to which money supply can change in the economy is 10,000 rupees. Can it be below this? Of course, yes. Right? Why? From one bank to another bank, they will give a loan. Right? It will go to, right, let's say, an individual, you and me. We may not deposit all the money back into a bank. Some of it, we might keep it for expenditure purposes. Cash can be kept like this. Right? So the amount of money, maximum change, it is 10,000 rupees. Now let me ask you simple. Imagine the CRR is reduced or CRR is increased now. CRR is increased. And as a result of this, 400 rupee, now it is not available for the banks to lend. And if the money multiplier is 4 times, tell me how much money supply will come down. Have you understand this? Right? The banks do not have 400 rupee to lend. The money multiplier is 4 times. The money supply maximum will come down by how much? 1,600 rupees. Simple calculation, 1,600 rupees. This is how, please be very careful. This is how RBI will use the tools to adjust the money supply in the economy. RBI will adjust the tools to adjust the money supply in the economy. Now, how does RBI measure money? Come to the table now. How does RBI measure the money? 5 types: M0, M1, M2, M3, and M4. M0, I've already told you, it is called as a high-powered money, monetary base. M1 and M2, narrow money. M3 and M4, broad money. Let me start with M0. Now, what is this M0? Simply remember the statement here. M0 represents liability of RBI. M0 represents liability of Reserve Bank of India. Sir, what do you mean by liability? Liability simply means, understand this, right? Liability simply means whatever has to be returned back by RBI. Whatever has to be given back by RBI. Before that, I've already cleared it to you. Currency that is published by RBI, which is there with the people. Currency published, printed by RBI, which is there with the people, the liability for RBI. Why? Please go back. Remember this. I've told it clearly to you. When RBI wants to supply this money, they will collect a certain amount or they will collect a certain product. Now people have 100 or bank has 100 rupee. They will approach RBI, give this money, the bank has to return back the G security. So that's the reason it is a liability of RBI. Right? So currency in circulation, liability of RBI. Bankers deposits with RBI. What do you mean by bankers deposit? A bank will keep CRR, cash reserve ratio, with RBI. Is it okay? The bank will keep cash reserve ratio with RBI. Right? So what is it? It's a deposit. Does RBI give it back? Of course, yes. It is a liability. If you have to give it back, it is a liability. Simple. Right? CRR is a liability for RBI. What about other deposits with RBI? Government of India has kept a deposit with RBI. Do they do that? Of course, yes. State government will keep a deposit with RBI. Don't you think any deposit you keep either with RBI, any bank, it's a liability? Any doubts here? Let me know. Any doubts here? Let me know. The money that is issued by RBI basically is a liability. Why? You have that 100 rupee. It simply means you have a claim over RBI. I'm using a technical language now. Right? You have a claim over RBI. That is, you can simply return the 100 rupee and collect the G security. So that 100 rupee which is issued by RBI becomes a liability. 2000 rupee becomes a liability. You are a bank, you will keep deposits with RBI. RBI has to give it back. That is a liability. Central government, state government have to keep deposit or they have kept a deposit with RBI, which is returned. That is a liability. So remember this, M0 refers to liability of RBI in the form of currency in circulation, other deposits held by RBI, and bankers' deposits kept with RBI. That is M0. Now, let me ask a very simple question. Follow the question carefully, answer it. If M0 increases, will the total money supply increase? I will repeat the statement here. Right? I'll repeat the statement. If M0 increases, Kiran, Lalit, right? And I'm unable to recollect the names now. They've passed very fast. Please be very careful. You're answering no. Why? Why the answer is no? Right? Just try to give me an argument why your answer is no. Because the answer is yes, it will increase the money supply. It should increase the money supply. Right, my dear? Please understand. If RBI prints more currency and gives it to a bank, will the money supply increase or decrease? Simple. It should increase. And when I take a name, please don't take it personally. There is nothing personal. I've not seen you. I don't know you. But I'm concerned about you. And if I'm concerned, I will tell you. Please look at your answer. Right? So understand this. Right? So whenever M0 increases, right, the money supply should increase. It simply means RBI printing more money, supplying more money in the economy. Money supply should increase. Come to M1 and M2. Come to M1 and M2. M1 and M2, I've already told you, both are referred to as narrow money. Sir, why are these referred to as narrow money? Simple. Follow this carefully. Whenever the money has high liquidity, it is called as narrow money. Have you understand this? Out of the total money which is supplied in the economy, whenever the money has high liquidity, it is called as narrow money. Sir, why are you using the term narrow? Because the money supply is very high. I'm not looking at all the money. I'm looking very narrowly. Narrow means my coverage is very, very less. That is narrow money. Now, what do you mean by broad money? Whenever liquidity is comparatively lower. Understand this. Right? Whenever the liquidity is comparatively lower, right, that is called as a broad money. Now, I can see many of you are asking, what is liquidity? Right? Yesterday itself, we have discussed it. Not 1 year ago. Yesterday, we have discussed it. So, where have you discussed it? Fiat money. We have discussed it in the context of fiat money. And it's not even been 24 hours, already forgotten. Right? It means you are not revising. I'm concerned about you. Anyways, come to this. M1 and M2, right, has very high liquidity. M3 and M4 has comparatively less liquidity. Now, what do you mean by this? Let me ask you a very simple question. Very, very simple question. Cash. 20 rupees cash. Highly liquid or less liquid? Let me know. The 20 rupee cash that I'm holding, highly liquid or less liquid? Right? Highest liquidity, absolute liquidity. Why? You don't need to convert it. You can use it to purchase any good or a service. Fixed deposit. High liquid or low liquidity? Fixed deposit. High liquid or low liquid? Land. Low liquid. Again, I'm talking about bank, so land is not required here. Let me add one more. The savings bank account. Let me see. What about savings bank account? Liquidity is high or liquidity low? Let me see. Savings bank account, high liquidity or low liquidity? High liquidity. Not as high as cash. Cash, absolute liquidity. Savings bank account, not as liquid as cash. But can I simply say liquidity is very high? You can withdraw the money at any point of time. Sir, but I will have to withdraw it. No then. Simply take out the check, write a check. Simply take out a debit card, swipe the debit card. Or simply take out Google, like Google Pay, and scan the QR code, transfer from account to account. Right? So liquidity, very, very high. Now understand my next question. I will write number 1, number 2, and number 3. And if you can understand this, narrow money, broad money, simple games for you. Now, if I want to classify all these 3, 1, 2, and 3, into those which are very highly liquid and which have low liquidity, what will you write under highly liquid? Let's start. What will you write under highly liquid? You'll write 1 and 2. Again, the savings bank account, yes, very, very high liquid. Not as liquid as cash, but very high liquid. What about low liquidity? You'll write 3. You'll write simply 3. Now come to the next point. What is narrow money? What is the definition of narrow money? Narrow money will consider only that part of the money where the liquidity is very high. I'll repeat the statement here. What is narrow money? Right? Rather than marking a formulas, this is how you need to understand the concepts. When you say narrow money, we are supposed to take care of the money that is very highly liquid. So when I say narrow money, can I simply say that it is mostly, there is one more component, I'll tell you that. It is mostly the cash as well as savings bank deposit. But rather than savings bank deposit, I'll replace this with a term called as demand deposit. Rather than writing the savings bank deposit, I'll replace that with the demand deposit. Now, is it okay if I say that narrow money, NM is equal to the cash which is there with the public, the cash that is there with all of us in the pocket, plus the demand deposit? Any doubts, let me know. Right? Any doubts, let me know. Right? Some of you are saying, what about fixed deposit, sir? Fixed deposit has lower liquidity. And when I say narrow money, my focus is on that money which has very high liquidity. So in the economy, which of the 3 has very high liquidity? 1 and 2 has very high liquidity. So I will count it. cash plus demand deposit, cash plus demand deposit. But have a look at this, there is one more component here, other deposits with RBI. Other deposits with RBI, that is, let's say state government has kept money with RBI, government of India has kept money with RBI, we generally count that also. Many of the books have not written it, but RBI writes it. Reserve Bank of India writes it. I've taken all of this from RBI document only. What is the argument of RBI? RBI simply says that the government of India, if they want to withdraw money, they can simply withdraw it. At any point of time, they can withdraw it. It is similar to a demand deposit only. So does it have high liquidity? Of course, yes. Have you understand this? It has high liquidity. So let's start the formula here now. M1, narrow money, a type of narrow money, the currency held by the public, the cash held by the public, plus demand deposit in the bank, because they can withdraw this money at any point of time, plus other deposits with Reserve Bank of India. That is the idea of narrow money in the form of M1. But there is another type of a narrow money, M2. Idea of M2. M2 takes M1 as it is, that is other deposits with RBI, cash with the public, demand deposits. To this, RBI will simply add post office savings deposit. To this, RBI will simply add post office savings deposits. So why are you writing post office savings deposits separately? First point, these monetary aggregates or the calculation that we are doing today was not given recently. This was introduced by RBI in 1990s, right? 2 decades ago. Now, simple question to you people. Simple question. What do you think was the saving habit of the people 2 decades ago? Do you think people used to save more money and keep it in the post office? Yes or no? 2 decades ago, by the way. I'll repeat the statement. 2 decades ago. I'm not talking today. I'm not talking about today. I'm talking about 2 decades ago, 1990s. Were people saving money and keeping deposits in the post office? Of course, yes. It was a prevalent thing. It was a very common thing. Right? Many of you are concerned. You're saying, no. Right? Don't worry. You're wrong. Don't worry. You're wrong. Why? Right? Some of you will say, sir, right? I was born at that point of time. How do I remember? Agreed. Valid argument. But please understand this. Right? Very, very old times. Right? For example, talk to a grandfather. You will understand it. They had this particular idea, or let's say they had this savings practice wherein they used to save money and deposit this in the post office. Sir, why? At that point of time, post offices were present throughout India. Compared to banking sector, post office availability was much higher. So that was relevant to them. Have you understand? That was relevant to them. Today, RBI says this is just a fraction. Have you understand this? Right? This is just a fraction. Even today, people deposit in post office. I'm not saying nobody does it. Even today, people do. But you tell me the answer. Today, the households deposit more money in the bank or the post office. Simple question. Households today save a lot of their money in a bank or post office. Banks have become the driving vehicle. Banks are the most important vehicles of savings of a household now. That is the reason what RBI does is, first we will take the deposits held in the banking sector, we will count M1. But historically, there has been prevalence of savings in the post office deposit also. And look at the statement of RBI. You might have kept money in the post office savings deposit, but the liquidity is low. Compared to what? Compared to demand deposits, the liquidity of post office savings deposit is lower. So I will calculate one more, that is M2, M1 plus post office savings deposits. Now let me go to the broad money. Broad money means what? Money supply, right? I'm looking at overall higher amount of money supply, even though it might have lower liquidity. Now tell me, you have counted cash. You have counted cash held by the public. Sir, where did I count it? M1 and M2. You have counted demand deposits. You have counted demand deposits. What else is left out? Right? What else is left out? Time deposit is left out. Is it okay? What else is left out? What kind of money circulation happens in the economy, but not counted? Time deposit. RBI says in M3 count that. In M3 count that also. So M1 as it is you take. M1 as it is you take. To the M1 you add time deposits that are there in the banking sector. And finally M4. Take M3 to this add post office savings deposit. Okay? Right? Take M3 to this add post office savings deposit. Now rather than you can mug up. I know all of you will by heart this only. My recommendation is simple. Don't simply by heart, understand the influence of it. Why does RBI count like this? Many of you are concerned now. Sir, what is the importance of it? Why does RBI count all of these money supplies? I will tell you the reason. You will only analyze it. Just give me a minute. But is it okay if I say that if RBI wants to control inflation, it has to reduce the money supply. If RBI wants to promote growth, it has to increase money supply. But how does RBI decide what to do when? How do they decide it? Let me give a very simple example to you. Understand the application part. Understand the application part. Let's start. So what is M1 by the way? What is M1? M1, I'll simply write the short form now. Cash with the public, demand deposit, and other deposit. This is M1. What is this M3? M3 is nothing but M1 plus time deposit. And what is M0? M0 is a liability. I'll take the most important part of it. Currency in circulation. Currency in circulation. Now let's try and understand what is the importance of it. Why does RBI calculate different things like this? Let me start asking questions to you people. Answer it. Apply the logic. I can directly answer it. Doesn't make any fun. Let's make it fun. If I give you 20 rupees, follow this carefully. If I give you 20 rupees and if you keep 20 rupees in the form of cash, what is the reason? Why do you keep this particular 20 rupees in the form of cash with yourself? What is the reason? Because you can take the 20 rupee and you can deposit in the bank also. Have to understand this. You can take the 20 rupee, deposit in the bank also. But why? Why do you keep it in the form of cash? Is it okay if I say that you are keeping this in the form of cash because you feel that there could be an expenditure? There could be an expenditure, right? Maybe today, tomorrow, day after tomorrow, etc. Right? Does it make sense? Let me know. Does it make sense to you? Otherwise, what you will simply do is keep it in the form of deposit. Now, some of you will say, sir, I can keep it in the form of savings bank account also. That's also a deposit. Agreed. Agreed. So either you will keep it in the form of cash with yourself, or right, you will keep it in a savings bank account. Why? The reason is simple. You want to use it whenever the demand arises. Right? You want to use it for consumption. Ajay says it doesn't make any sense. I don't know how you operate, but this is how economy operates. Let me ask you a second question. Same 20 rupees I will give it to you. Now you say, sir, I will not keep it in the form of cash. I will not deposit in the savings bank account. Rather, I will deposit in fixed deposit. I will keep this in the fixed deposit. Now tell me why. Why do you think you keep the 20 rupees in a fixed deposit? right? Why not keep it in the form of a cash, or why not in the SB account? Your reason is, sir, this 20 rupees is not useful for me today. I don't have any use of this 20 rupees today. Rather than keeping it in the form of a cash, what I will do is, I will keep it in the form of FD, so that one, I don't have immediate requirement, and second, I will earn a certain interest, right? It should make sense to you. Now, apply the logic. Apply the logic. Imagine RBI increases the money supply by 100 rupee. RBI will increase the money supply by 100 rupee. Cash held by the public increases. The amount in the savings bank account increases. What is the indicator? You tell me what is the indicator. I have to understand the meaning here. RBI supplies the money by 100 rupee, and the cash held by the public increases, and the money that is there in the demand deposit increases. What is the inference you're drawing? What is the indicator? Indicator is people are keeping a lot of money for expenditure. People are keeping a lot of money for expenditure, for consumption purposes. Now, at this point of time, you tell me, your RBI governor, should you increase the money supply? Should you decrease the money supply? Start answering. Should you increase the money supply? Should you decrease the money supply? Straightforward answer, decrease the money supply. Why? People already have a lot of money with them. I have to understand this. People have a lot of money for consumption. People are purchasing a lot of goods and services. If you further increase the money supply, that will contribute to inflation. Don't you think RBI should do the exact opposite, reduce money supply? Let me ask you a second point here. You know that M1 is very high. Understand statement here. You know that M1 is increasing very, very high. Should you increase the CRR or should you decrease the CRR? Apply the knowledge. Right? You know that M1 is very, very high. Should you increase the CRR or decrease the CRR? Couple of you are saying decrease. Focus very, very carefully. You should increase the CRR. You should increase the CRR. My dear, what is the logic of decreasing CRR when money supply will further increase and you already know that M1 is very high? Don't you think if you are RBI governor, if you reduce CRR, and when M1 is very high, you are going to cause inflation in the economy. You are going to cause inflation in the economy. Right? So understand. Right? This is how RBI operates. So what is the use of M1, M2? I simply mugged up, by hearted it. UPSC will ask you this. UPSC will ask you this. Now you are looking left, right, forward, backward in the examination hall without understanding the concept. Let me give you another situation. M3 is increasing. M1 is same. It is not changing. M3 is increasing. M1 is same, not changing. What should be the object of RBI? Should RBI increase the money supply or decrease the money supply? I'll repeat the statement. Right? M1 is same. It is not changing. But M3 is increasing continuously. What should RBI do? Increase the money supply, decrease the money supply. Print more money and give. Reduce CRR, or they should do opposite. Most of you are answering correctly. I'm happy. RBI should increase the money supply. Now those who are answering like decrease money supply, they're like, how? Magic? Right? Is it a magic or what? How do you say that M1 is stable, but M3 is increasing and RBI needs to increase money supply? What is the reason here? Understand the logic. M3 has a time and deposits. Understand the difference between M1 and M3. What is the difference? Time and deposit. And already you've answered. Why do you keep more money in the time deposit? Because you want to save more. If you start saving more in the form of time deposit, what about the demand in the economy? What will happen to demand in the economy? Will the demand in the economy increase or decrease? Demand in the economy will start decreasing, falling. Don't you think that's a concern for RBI? So in order to promote growth, RBI has to increase money supply. I have to understand the meaning of all of these. Don't simply by heart them, because I know books have given formulas and have moved forward. Rather than by hearting them, mugging them up, understand the logic behind it. Why does RBI do it? Then automatically you'll be able to address the questions asked by UPSC. Okay, let me go to the next one. Last couple of functions of RBI. Last couple of functions. Banker to the banks. RBI is also referred to as Bank of Last Resort. Bank of Last Resort. Right? RBI is also regulator of the banking sector. Why it is? Understand this. Why it is referred as a banker to banks? Simple. The banks are allowed to take loan from RBI. We have discussed this. Repo rate, bank rate. Are the banks allowed to take a loan from RBI? Of course, yes. Banker to banks. Then apart from this, it is also referred to as Bank of Last Resort. Apart from this, it is also referred to as Bank of Last Resort. Why? If you are running a bank and there is an emergency requirement. Today you don't have sufficient amount of money. There is an emergency. You can always approach RBI and borrow. I have to understand this. In case of emergency situations, the banks are allowed to borrow, right? The banks are allowed to borrow from RBI. That is the reason this is referred as Bank of Last Resort. Why it is referred as a regulator of bank sector? Anything to do in a bank. For example, imagine you want to start a bank. You'll have to take the permission of RBI. You want to purchase one more bank, acquire it, take the permission of RBI. You want to open number of branches, take the permission of RBI. You want to open ATMs, take the approval of RBI. So for any function related to the bank, RBI is the regulator, hence regulator of the banking sector. Next one, manager of forex reserves. Manager of forex reserves. Let me start with the basics here. Manager of forex reserves. Forex stands for foreign exchange. Forex stands for foreign exchange. This is a short form. Forex is the short form of foreign exchange. Now understand this concept. Foreign exchange comprises 4 components. I'll repeat the statement here. Foreign exchange comprises, that is, it is made up of 4 components. What are the 4 components? First one, gold reserves. Gold reserves. Just like many central banks around the world, RBI has also purchased a lot of gold, kept it with itself. Now many of you will ask me, sir, why? Why the central bankers run behind the gold? Simple, already you know the answer, I've discussed it. Gold acts as a hedge against inflation. Gold acts as a counter against inflation. Why? If RBI keeps money like this, if RBI keeps money, because of inflation, the purchasing power of money will keep on decreasing. Rather than this, what the banks do is, that is RBI, what the central banks do is, they will use this money, purchase gold. Because again, remember this, when you look at the prices of the gold for 5 years, 10 years, etc., prices of the gold generally increase like this. So to hedge against inflation, central banks purchase a lot of gold, maintain the gold reserves. That's the first thing. Second, SDR, special drawing right. I've discussed 2, 3, 4. So please be very careful here. While I'm writing numbers here, I will cover 2 and 4. I will cover 2 and 4 when I discuss IMF. Is it okay? I'll repeat it. Right? I'll cover 2 and 4 when I discuss IMF, International Monetary Fund, because it takes time. Let's not get deviated to IMF. Let's stick to discussion on RBI. So one, it will maintain gold reserves. It also has a component called as special drawing rights, not today. It also has reserve tranche, not today. We'll discuss under IMF. And the fourth, most important component is foreign currency assets. Foreign currency assets, FCA. What is the foreign currency asset here? RBI will hold dollars and maintaining certain number of dollars. They also have pound, they have euros, right? They have yuan, etc. They have foreign currencies, custodian. They maintain certain foreign currencies with them. In addition to this, they will also hold certain bonds of, let's say, US government, of, let's say, Japanese government, or let's say UK government. All of these put together is referred to as basket of foreign currency assets. Is it okay? I'll repeat it. RBI will hold certain foreign currencies. What is the use, sir? We'll understand it later. Please don't worry. RBI will also hold certain bonds of foreign governments. Put together all of this, you'll get foreign currency asset. So whenever you say custodian or manager of forex reserves, it simply refers to 4 components which are held by RBI, Reserve Bank of India. 1 plus 2 plus 3 plus 4, it is the forex reserves. And so this is one more function of Reserve Bank of India. But any doubts so far, let me know. Before I go forward, any doubts so far, let me know. Because this is the monetary policy. Monetary policy plus function of RBI are done and dusted. Have you understand this? Monetary policy as well as, right, the functions of RBI done and dusted. We have covered so many concepts under this. I know a lot of concepts are there. All these are important. Trust me, all these are important. Okay. Why does RBI purchase gold? Same story all over again. I said, during the period of inflation, during the periods of volatility, gold offers a very safe investment to you. Why? Gold prices in a longer duration always increase. And that is the reason they will purchase and hold gold. Time is over. Who said time is, Baba? 9:30. Till 9:30 we have class. You did not discuss the use of forex. Did I say this is a complete detail of forex? I told you IMF I have to discuss. I told you international trade I have to discuss. Exchange rate I have to discuss. Wait. Why do you want to jump the gun? Right? You will not understand even if I discuss now. Reserve tranche, when I take up IMF. When I take up IMF, I'll discuss reserve tranche. Can any normal person open an account with RBI? Generally, individuals are not allowed to open an RBI account. But please understand, there's a special facility also for RBI governors. They allow them to open an account with RBI. But can I go to RBI office and open an account? No, they will not allow it. Okay, because RBI doesn't deal with individuals. RBI directly deals with banks. And banks deal with individuals or companies for that matter. So MSF not discussed, I'll discuss it. Don't worry, I'll discuss it. Marginal standing facility, I'll discuss it. Now, before I go forward, right, understand this because you've asked, let me cover it here only. There is a tool used by RBI called as marginal standing facility. Marginal standing facility. Now, what do you mean by marginal standing facility? Under the marginal standing facility, MSF, RBI will provide loans for short term. I repeat, under the marginal standing facility, RBI will provide loans for short term. What do you mean by short term here? Literally for one day. Literally for overnight purposes. Sir, why? Why will the banks borrow for overnight purposes? Imagine, right, understand this. Imagine a particular bank is supposed to maintain certain amount of cash, not the deposit, cash with them. There's a guideline. RBI has a guideline for it. Right? So a bank is supposed to maintain a cash of, let's say, 100 crore rupees at the end of the day. But for whatever reason, they do not have that much amount of a cash. So in that particular situation, only for that day, only for that particular day, they are allowed to borrow for one day from RBI under the tool called as marginal standing facility. So understand the logic here. RBI says that we told you the guidelines earlier. I told you that you are supposed to maintain 100 crore rupee cash by end of the day because you have not managed your operations correctly. Because you did not manage your operations correctly, you don't have 100 crore rupees. So no doubt, I will give you a loan. I will give you a loan for one day. But because you are not managing your operations correctly, I will penalize you. Understand this. I will penalize you. That is marginal standing facility. Under this, RBI imposes a penalty on these particular banks. RBI says, because your mismanagement, you're not managing your operations correctly, there's a problem with your numbers. So what I will do? I will allow you to borrow, but I will not charge you a normal rate of interest. I will charge you a higher rate of interest. Higher in the sense, the rate of interest charged under MSF. The rate of interest charged under MSF is greater than repo rate. Remember this. The rate of interest charged under MSF, right? There is a higher rate of interest higher than repo rate. And now look at this. Highest is MSF. Below that is repo rate. Below that is the standing deposit facility. And below that, it is the reverse repo rate. Any doubts in understanding this? Highest rate of interest that RBI charges, right, is MSF. Below that is repo rate. Below that is STF. Below that is reverse repo rate. Sir, what about the bank rate? Bank rate is generally here. Along with the MSF, the bank rate is there. Or both of them are equal generally. Both of them are equal. Now understand this next point carefully. Although we have 4 to 5 rates like this, whenever RBI wants to change the rates, they will simply change repo rate. If you don't understand this, please take out your newspapers. Very recently, RBI conducted a monetary policy. Just look at what RBI governor said. RBI governor will simply say, we will change the repo rate. We have increased the repo rate. We have decreased the repo rate. Now your question will be, sir, when they increase or decrease the repo rate, what will happen to MSF? What will happen to bank rate? What will happen to STF? What will happen to reverse repo rate? What will happen for all of them? Remember this very carefully. Repo rate is the policy rate. Repo rate is the policy rate. And when repo rate changes, automatically all the other interest rates will change. I will repeat the statement here. When repo rate changes, automatically all the other interest rates will change in the same direction, by the way. For example, right, understand this carefully. Imagine repo rate is 4% and STF is 3.5%. Imagine this number. Now, if RBI increases the repo rate from 4% to 4.5%, from 4% to 4.5% means what? They've increased the repo rate by 0.5%. Automatically, I repeat, automatically the STF will increase from 3.5% to 4%. RBI governor doesn't have to say it. Why? They have linked all the other rates with simply the repo rate. And if the repo rate changes, automatically the remaining rates will get adjusted in the same manner. You'll have to remember this point. Please remember this particular point, right? Because when RBI governor will give a speech in the monetary policy discussion, RBI governor simply says, I will change the repo rate. RBI governor will not tell you, right, I'm going to change the reverse repo rate also. I'm going to change SDF also. I'm going to change the MSF also, etc. No, they don't do that. If you don't trust me, please take out the newspaper and read it. You will realize it. So what does it mean? Other rates are connected to repo rate. And if repo rate changes, everything else will automatically change by the same number. Done? Now the next concept is surplus transfer. Okay, surplus transfer will take time. Let me take up the smaller concept. I repeat, surplus transfer takes time. Let me take another smaller concept instead of it. Next concept is DICGC. Don't panic and say, sir, what about surplus transfer? Next class, I'll discuss. I'll discuss it in the next class. Don't be bothered about it. Focus on this. Next is the DICGC. Right? What is this DICGC? Sir, long form of DICGC, Deposit Insurance and Credit Guarantee Corporation. Deposit Insurance and Credit Guarantee Corporation. This is a long form. But what is the authority? What is the use of this authority? Let me start with a very simple example. Imagine you have 100 rupees. You will take that 100 rupee, go to a bank and deposit this 100 rupee. Deposit this particular 100 rupees. Now have a look at this very carefully. What if the bank takes 100 rupee, gives it as a loan to a company? Company incurs a loss. The company is unable to pay the amount back to the bank. The bank now incurs a loss. Is it okay if I say that the bank will not have any money to give the money to you back? Is it okay? I'll repeat the statement. The bank will not have any money to give your money back to you because the bank has incurred a loss. Bank is shutting down now. What will happen to your deposit? What about your deposit now? That is where the DICGC will come into picture. Right? I told you in the beginning. Now two people are asking, sir, long form of DICGC. Right? I told you in the beginning itself, and in fact, there's an arrow mark also in the PPT slide. Right? At least observe. Forget about what I say. At least observe. There is an arrow mark. There is a nice yellow color arrow mark. DICGC stands for Deposit Insurance and Credit Guarantee Corporation. Now, what generally happens is, follow this carefully. Whenever you keep deposits in the banks will take insurance for these deposits. I repeat the statement here. Whenever you keep deposits in the bank, these banks will basically take insurance against these deposits. How? That the banks will pay certain amount of money to an authority called as a DICGC, and the DICGC will provide insurance for these deposits. For example, right now I'll tell you this is a current affairs. Please update it. Right now, for every 100 rupee that the bank wants to insure, they will have to pay 20 paise to DICGC, 12 paise to DICGC. I'll repeat the statement here. The bank, if they want to provide insurance for 100 rupee worth of the deposit, the bank from their pocket, not from your pocket, not from my pocket, the banks from their pocket will have to pay how much? 12 paise for every 100 rupees to DICGC. And what DICGC does is, they provide insurance to these deposits, and if the bank fails, the bank is shutting down, you don't have to be worried, your money will be given back to you. The amount of deposit will be given back to you. Now, one person is asking, what is insurance? Tell me, what is insurance? Right? In case of loss, you have a provision. That is an insurance. If you ask me, sir, even what is insurance? And many of the times when I'm discussing infrastructure, I say, let's discuss road infrastructure. You people ask me, sir, what do you mean by road? Right? So, at least these kind of questions you should not have. Right? Again, you can ask, I will answer, but that is a cause for concern. That is a cause for concern. Why? You have a two-wheeler with you. You might be having a four-wheeler with you. You already have a life insurance. Now tell me, without knowing the term insurance, did you get the insurance? I have to understand. Without knowing the term insurance, did you get the insurance done for your life? Did you get the insurance done for your vehicle? Right, Baba, please focus. So what will happen here? That the bank will give certain premium charges to DICGC, and DICGC will provide insurance to your deposit. And the use of this is, if the bank fails, if the bank is shutting down, you are not supposed to be concerned. You don't have to be worried about your deposit. But there is a clause here. There is a one important condition. What is the condition? And what is the condition here? The condition that the DICGC will provide insurance coverage for up to 5 lakh rupees of the deposits. Important, remember this. DICGC, right? The DICGC will not provide insurance beyond 5 lakh rupees. It will provide insurance only up to 5 lakh rupees of the deposits. Meaning what? Imagine your deposit is 2 lakh rupees. Imagine your deposit is 2 lakh rupees. Your deposits of 2 lakh completely are insured. If the bank loses money, they are shutting down. You will get the complete 2 lakh rupees. What if you have 10 lakh rupees in the deposits? Right? What if you have 10 lakh rupees in the deposits? Then DICGC says, I'm sorry for your loss, but I will not cover full 10 lakh rupees. I will cover only 5 lakh rupees. That is, I will provide you 5 lakh rupees. Rest of the 5 lakh, imagine you put that in the Tirupati Hundi. That's it. Imagine you put it in the Tirupati Hundi. That's it. Forget about it. And that is the basic idea for DICGC. Now, why this is important? DICGC until now was not very famous, was not known. But in the last couple of years, some of the things or some of the events have taken place in the economy. What kind of events? There was a cooperative bank by the name of Punjab Maharashtra Cooperative Bank. Have you understand this? Right? Understand this. There was a bank by the name of Punjab and Maharashtra Cooperative Bank, PMC. This Punjab and Maharashtra Cooperative Bank had basically collected a lot of deposits, and it went under means incurred huge amount of a loss. Now, who will provide the deposits of the deposits? Who will give the money of the depositors now? That is the precise reason. Okay, that is the precise reason. Government of India, though this is a very old authority, DICGC has been set up with the passage of the DICGC Act of 1961. But until very recently, the coverage of insurance was limited to 1 lakh rupees. I'll repeat. Until recently, the coverage of insurance was limited to 1 lakh rupees. Up to 1 lakh rupees of the deposits were covered. Now, this has been increased to 5 lakh rupees. Is it okay? This has been increased to 5 lakh rupees. So, what is a WEF? With effect from. WEF simply stands for with effect from. So, with effect from 2020, Government of India has increased the insurance coverage provided for the deposits to 5 lakh rupees now. Very important. Remember, let me add one more very important current affairs point here. Now, RBI says, that is Government of India through an order says, if a bank fails means what? The bank says, I don't have money to give it back to you. And please understand, it is not just saying. They will give a report, they will report this to Reserve Bank of India. They'll go to RBI and say, sorry, we don't have money, we have mismanaged it, now we do not have money to give it back to the people, that is depositors. So from that date, understand this, from the date of reporting to RBI, in the next 90 days, this is the latest information, right? In the next 90 days, DICGC has to provide the money, insurance money to the depositors. I will repeat the statement here, I'll repeat the statement. The government of India now says, from the date of reporting to RBI about the failure of the bank, in the next 90 days itself, DICGC is supposed to provide, the insurance money to the depositors. Why this is important? Until now, this guideline was not there. Have you understand this? Until now, this guideline was not there. DICGC used to take months together, years together to give the deposit amount back to customers. And that will cause anxiety. That will create panic among the customers. So government of India now says, cover the insurance amount up to 5 lakh rupees, plus ensure that in 90 days, customers will get their money back. Customers will get their deposit back. Now, what kind of a bank deposits are covered? Which type of banks are covered under DICGC? Deposits with all the commercial banks, cooperative banks, except the primary cooperative societies. Remember this. The deposits with all the banks except the primary cooperative societies. Why? Sir, why the deposits with primary cooperative societies are not covered? The reason is simple. RBI says these are societies, not banks. Is it okay? I'll repeat the statement here. These are societies, not banks. Sir, what do you mean by society? Next class, when I discuss cooperatives, I'll teach you there. I will tell you what is the meaning of a cooperative society in India. In fact, this is there very often. It is cited in the newspaper. I'll tell you a current affairs example also. Apart from Mr. Amit Shah's speech, one more very important current affairs. Let me ask you the question first. Any recent committee, underline the term, any recent committee which has been set up by the government regarding cooperatives. Let me see whether you people are reading the current affairs correctly or not. Any recent committee which has been set up by the government of India for cooperative societies. If you say yes, who is heading that particular committee? Let me know. Who is heading that particular committee? Amit Shah. Arey nahi baba. Amit Shah is not heading that particular committee. Suresh Prabhu. Mr. Suresh Prabhu is heading that particular committee. Yesterday it was there in the newspaper, not in Hindu. That is a problem. Yesterday it was there in the other newspapers. So please be very careful. We have set up a very big committee, very big committee, and we expect that particular committee to give a guidelines, a policy for cooperatives in India. What is the side of a cooperative banking, etc.? We'll discuss that next week, next class. Please don't worry. Right? Please don't worry. Right? Mr. N.S. Vishwanathan committee is more associated with urban cooperatives, not for all the cooperatives. Yesterday itself, that is the day for yesterday, this announcement was done. Anyways, so have a look at this. The banks which are covered under this is all the types of banks, right? Public sector bank, private sector bank, regional rural bank. All the banks are covered except the primary cooperative societies, because these are not the banks. These are not banks, these are societies. And the last point for today, DICGC is owned by Reserve Bank of India. I'll repeat the statement here. DICGC is owned by Reserve Bank of India. It is a subsidiary. Subsidiary means what? It comes under the ownership of Reserve Bank of India. Done. So these are some of the very important points regarding DICGC. Please be very careful. Sir, explain bankruptcy. Don't worry, we'll discuss it. Right? Chapter of banking is not at all. We'll discuss. There is idea of IBC, etc., etc. We'll discuss that. Please don't worry. Okay, let me take up certain questions from your side. RBI gives